What we all know is that earnings estimates continue to rip higher.
2026 earnings are going to be okay.
The chip names have done a great deal of the heavy lifting.
If we see a broadening, that would be a healthy sign in this market.
We think there's probably more weakness coming through the summer months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, more fuel for the bulls. Equity futures pushing higher. Micron crushing estimates as Wall Street banks are getting a green light to boost payouts. Crude is declining, wiping out a major wartime rally heading into the latest read on inflation.
Will that be enough to dampen the enthusiasm that we're seeing in so many parts of U.S. equity markets as well as certain parts of the economy? And that's emphasized by what we saw from the stress tests as well as Micron earnings. Yes, on one hand, it is disinflationary that oil prices are coming down. Still, core PCE is set to come in at 4.1%, which would be the highest since April of 2023. And some of the contracts that are leading to these elevated prices are locked in for the next 5 years. So it doesn't seem like that is going to be anytime soon.
Pricing power, margins. Check out Micron this morning. 85% margins over at that company.
If anyone was doubting just how much pricing power they actually had, well, they're not having a good day today because ultimately they proved all doubters wrong and it came in with $50 billion of revenue in the fiscal fourth quarter. That compares to $43.2 billion. When you start beating by $7 billion, the net expectations for some of the net margins was far below that 85%. They can control a market. They can lock people in for the next 5 years. They can get upfront payments, and still they are running out of chips to sell.
85% for gross margins is insane. It not only beat their own expectations, it also beat what they did last quarter. A year ago, 39%, that's how much they were up. And this also beat NVIDIA. It's starting to feel like Micron maybe has a little bit of the new cool kid on the block, the new NVIDIA of the street.
Stock is up in the pre-market by 16%. Good news there. For the banks, good news there. For crude, good news there. Check out crude. WTI and Brent this morning. WTI in the 60s, 69. Brent 72, wiping out the wartime rally. A 60+% move at one point. All gone.
All gone. So basically, we are back to pre-war levels. At the same time, the AI trade is continuing, and that is why there's so much positivity and momentum. You know, Jim Reed of Deutsche Bank put this in one of his notes. It's not just the fact that oil keeps moving. It's the fact there's a lot of officials coming out. The president this week had said this, and a number of other individuals, Marco Rubio, Secretary of State, individuals in the Gulf, said also they don't see Iran having a tolling right now. They're not tolling for these vessels, which basically everyone is starting to feel like maybe we are somewhat going back to normal when it comes to the Strait of Hormuz.
So I think this is good news, but there's always something to worry about. Thank you, Torsten Slok, over at Apollo, with this quote. The narrative in markets is changing from lower oil prices mean lower inflation to lower oil prices mean more demand in an already overheating economy, which means higher inflation.
Yeah. You're even hearing this over at the ECB, ironically enough. Isabel Schnabel coming out and saying we can't let up our vigilance on inflation even if oil prices are coming down. This, as the ECB's Christine Lagarde at least, has a different tone. Nonetheless, this is sort of the push-pull of markets right now. On one hand, you've got Micron able to charge whatever they want for people who can't get enough of their memory chips. And on the other hand, yes, you have one disinflationary input from oil prices. How does this come out? How do people see core PCE? How many people are going to say we're seeing peak acceleration in inflation versus the people saying, hold on a second, it's services sectors, it's also the rare earth metals and a whole host of other components.
Apparently things are so good it's bad. Equity futures this morning up by 0.75%.
My kind of thinking.
On the S&P 500. Coming up this hour, Sebastien Page of T. Rowe Price as tech bounces back. Terry Haines of Pangaea Policy as President Trump clashes with Republican senators. And Angelo Zino of CFRA as Micron is breathing new life into the AI trade. We begin this hour with stocks pushing higher following a boost from Micron's blowout earnings report. Sebastien Page of T. Rowe Price writing AI is an expanding theme from GPUs to other bottlenecks along the data center supply chain, as Buzz Lightyear said, to infinity and beyond. Sebastien joins us now for more. Seb, welcome back to the program, buddy. Are you just saying stay on, grip tight, keep riding this bull?
John, when I wrote my notes, I didn't think you'd pick up on the Buzz Lightyear quote. I'm going to be honest. We have an expanding trade from bottlenecks to, more and more bottlenecks. You're looking at cooling, at electrification, at aerospace, at gas turbines. We're invested in those bottlenecks. We think it's a trade that has legs. Look, the AI build out, a lot of people mentioned those forecasts on your show, but we're looking at $3 trillion by 2028. So it's a trade, and it's going to continue to go, in my mind. The key question right now is, when is this going to show in AI users' margins? Now, we have 300 analysts on our platform. I read their notes, but now I use AI to read their notes, and I ask AI, where are we seeing companies in our own proprietary research that are increasing their margins because they're using AI? Now, I've seen estimates out there, John, that are, I think, exaggerated, but anecdotally, we're starting to see this as well in the users of AI. This will be the next leg. So I think the technology revolution will continue. I'm conscious as I say this, I sound a little bit like Dan Ives, but yeah, we're long U.S. large cap growth stocks.
So I'll push back just a little bit, and I'll give you the alternative view on things, Seb, where the economics of all of this get a little bit complicated. So the cost to build out capacity is increasing. We can see that evidenced by some of the margins at some of these companies at a time when the end user demand is getting a little bit fragile with regards to pricing overall, and they're rationing spending on AI. How's that going to make sense going forward? What do we need to rationalize here?
Look, as long as the products keep improving, and they are, there is tremendous demand for it. It looks to me like we're still scratching the surface on demand and usage of AI. And by the way, John, I completely take the point that this spending is gigantic and free cash flows are coming down really fast for a lot of the hyperscalers. But, if you think about it, the price earnings on the Russell 1000 growth, we were in the 30 range. We peaked at 30 several times over the last 5 years. John, we're at 22. So there is, trust the market. There is an adjustment here that's been made. This is in the bottom for Russell 1000 growth valuation. This is in the bottom 30% of the last 10-year range. You can also play AI bottlenecks, by the way, in other areas. You can also play them in small and mid cap, which we're long too. We have this barbell between U.S. large cap growth and small and mid cap. We're talking about the golden component. Once you have a component that becomes a part, just a bottleneck, a part of that electrification, power supply, data center, whatever it is, your company stock goes vertical. Also, emerging markets, a lot of people mention this on surveillance. Emerging markets are becoming part of that trade. So, yeah, I mean, it's a position you need to balance. You need to diversify the risk in the portfolio. For example, I still think there's inflation risk in the portfolio, and at some point that becomes part of the supplying the energy to AI, that becomes part of the picture.
We'll pick up on that in just 1 second, Seb. You're talking about trying to race to find the next bottleneck where you can see stocks go vertical, akin to what we're seeing with Micron this morning. I just wonder if people truly are understanding, or if it's a healthy technical to just have a rolling ball of cash. On one hand, people are chasing who has pricing power. On the other hand, Google shares down 8% this month. Microsoft poised for its worst monthly loss going back to 2008 of 19% losses. The payers of this bill are getting penalized. At what point is that a warning sign?
I mean, it is absolutely, Lisa. You have winners and losers, and this is why skilled active management and fundamental research is working here. You're going to have software companies that are going to be disrupted, but you're going to have companies that, I think increasingly the next leg of this is along the bottlenecks to eventually the handoff to the users that are going to create real efficiency. I see it in our company. We're creating efficiency. We're improving our processes. It's really that's going to be the next leg, and that's what is going to keep it going. And again, I go back to the fact that it's not, a lot of this increase in leverage and borrowing and decrease in free cash flow margins, a lot of it has been adjusted in the price. 22 relative to the 30 range in prior episodes over the last 5 years, I think is pretty good for Russell 1000 growth.
So, Seb, could you justify the investment in further AI if the borrowing costs were higher in the face of inflation, in the face of some of this acceleration that we're seeing in other components and price components that everyone's trying to chase?
Well, the reality is that this $3 trillion in spending, a lot of it is generated by companies that still have a ton of cash. I don't like the comparisons to the dot-com bubble, but we're nowhere near the level of corporate leverage in aggregate that we had. So yes, there is some borrowing, but if you look at the metrics by historical standards, it's not a very high level of leverage by historical standards. And there is tremendous capital that's available, as we're seeing with IPOs and those debt issuance. I think there is demand for the end product. At the end of the day, that's what really matters. People want to use it. There are billions of users already. They're just scratching the surface. I'm doing roundtables with investors, and I realize a lot of them, my peers, a lot of them are just starting. It makes me happy because I feel like we're really ahead in how we're using agents and so on in our investment process. But also it makes me think that as long as the demand for the end product is there, people are willing to pay for it. We'll go through ups and downs. We'll go through episodes where tokens get more expensive and people go to cheaper models and so on. But the trend is our friend here, $3 trillion spending by 28. Again, Lisa, I didn't think I'd come in this morning and sound like Dan Ives, but we do have a long position in U.S. large cap growth. And, we do believe in the AI bottlenecks and the expansion of that trade.
You also are concerned that even with oil prices becoming lower, that you actually think there's still a lot of inflation baked into the system. Is the Fed potentially having to maybe hike going to be an issue for where you see the market going and your Dan Ives bullishness this morning?
Yeah, look, Annmarie, if we get like 25 basis points, 50 basis points of hikes, I don't think that's a big issue for markets. I do think generally, though, inflation right now is underestimated as a risk. You had the Torsten Slok quote earlier. I would argue that he's right. I would agree with that. Yes, oil prices are coming back down really quickly. My view is that there's pent-up inflation. There are lots of lags in inflation data and in inflation itself. You have from fertilizer to food, from freight and insurance to transportation to industrial production to the final goods, from fiscal stimulus to demand. There's lots of lags that are working their way through. By the way, the last 3 months on the rolling basis, the headline CPI is up 8% if you annualize it. You're not supposed to annualize 3 months. It's noisy data, but still 8%. But the shelter for the last 3 months is 4.8%. There's also a lagged effect here with prior rent increases. Now, put all of this in context of the fact that the break-even for the one-year horizon is 1.7%, and the one-year inflation swap is 2.2%. So in my mind, it's still an underestimated risk, especially for the next 3 to 6 months. In the long run, yeah, we'll normalize. But I think the market is underpricing the inflation risk. I guess we have a print this morning. We'll see. I watch surveillance often with a 12 or 24-hour lag. And I'm mindful that some people come in and make forecasts a few minutes before the data release. I'm not going to make that. I'm not going to do that this morning. It's always interesting to listen to it after the fact when you know what happened. But as a general trend, I'm not talking necessarily PCE, maybe 4% this morning, but as a general trend, the inflation here is underestimated by the market based on the pricing you see in break-evens and inflation swaps.
Not enough to upend this rally, though. Seb, it's good to see you. Sebastien Page of T. Rowe Price, at least not for now. For now, CapEx takers over spenders. We'll catch up with Ohsung Kwon of Wells Fargo later this morning. That's his trade. That's the trade that's worked. You mentioned the hyperscalers. The likes of Meta and Microsoft, those stocks are in a bear market. They've really struggled. Micron is not a struggle. That is surging this morning.
You've been talking about the transfer of wealth, and right now the market is embracing the transfer of wealth and trying to look toward who has that pricing power, who has the next 85% pricing power. I can give advice, and I will charge you something, and ultimately, maybe I can make an 85% profit margin.
90% margins, Bramo,
yeah.
for you.
Yeah, exactly.
Obviously, Micron up by 16 to 17%.
Just kidding.
In the pre-market. Equity futures right now up by 0.8% on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Back-to-back earthquakes devastating Venezuela. The biggest quakes in the country's history, toppling buildings in Caracas, knocking down power lines and damaging the capital's main airport. At least 32 people have been confirmed dead and more than 700 injured so far in the quakes. All of the biggest US banks passing the Fed's annual stress tests, allowing them to boost buybacks and dividends. The exam, which is a result of the GFC, assesses how 32 large lenders would withstand a severe global shock among scenarios. The Fed saying the results underscore the strength of the banking system. Micron shares surging in the pre-market, the largest US maker of computer memory chips giving a quarterly forecast that easily topped Wall Street estimates, signaling an AI-fueled growth run remains strong. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, struggling to maintain a united front.
We're very proud of the party. I don't like a few people, but that's okay. I think you know who they are. I'll give you that information someday. But for the most part, we have a really well-unified party.
Did someone call him brother yesterday at this meeting?
Yes.
OK. Terry Haines of Pangaea Policy can translate all of that in just a moment. Live from New York City this morning. Good morning. Crushing estimates, 85% margins. More on this name throughout the programme. Micron in the pre-market up by 17%. Here's the follow-through. A snapshot of equity here in the US. Equity futures pushing high on the S&P 500 up by 0.8. Outperformance on the NASDAQ up by 2.2%. Under surveillance this morning, let's head to Washington. Struggling to maintain a united front.
We're very proud of the party. We like our leader. We like everybody really in the room. I don't like a few people, but that's okay. I think you know who they are. But I'll give you that information someday. But for the most part, we have a really well-unified party.
So here's the latest this morning. The president showing some solidarity with GOP senators after a closed-door meeting devolved into a shouting match on Capitol Hill. One senator saying the president was, quote, mad as a murder hornet. Bloomberg's Tyler Kendall joins us now for the latest. Good morning, Tyler.
Hey, John, good morning. I mean, to be a fly on the wall for this closed-door contentious meeting yesterday between President Trump and Senate Republicans, there are really two issues at play here. The first is that yesterday President Trump abruptly canceled this signing ceremony for the recently passed bipartisan housing bill, which Republicans want to campaign on. He says he's not going to sign that legislation until they put forward his voter ID Act. But at this point, that doesn't really seem like a plausible outcome. Senate Republicans have been telling President Trump for months that the votes are not there, though House Speaker Mike Johnson is headed towards the White House later today. That's something to watch, as it appears they're going to try to take some of these provisions and get it through the partisan reconciliation process, but it's not totally clear that will even pass the budgetary standards. The second issue is the one that you mentioned, that we just saw the Senate rebuke President Trump over the conflict in Iran, with 4 Republicans crossing party lines. That included Senator Bill Cassidy, who recently lost his re-election bid after failing to secure President Trump's endorsement. He told reporters that they got into a heated exchange, saying that he, quote, lost his temper, but that he matched President Trump's tone and volume. John, still, it does appear some progress actually might have been made. Yesterday, Cassidy abruptly switched his vote on a separate war powers resolution after he received a briefing at the White House, and so did Senator Rand Paul, who said that he understood President Trump's argument in the room yesterday that without a unified Congress, the U.S. could lose leverage at the negotiating table.
Tyler, appreciate the update. More from Tyler throughout this morning. Live from the nation's capital, Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the programme. Is this more than just about war heading into the midterms?
Good morning, John. I think I think it's perfectly normal that the pot boils over sometimes. I think people would hopefully not be surprised that privately, people talk to each other pretty frankly in politics, and this certainly is the case today, particularly with people that the president didn't support. But the through line is a couple of things. The through line is it's not really about the war so much as it is the not tying the president's hands in negotiations. That became very clear, and it's also about the path forward, which has a lot to do with funding for the war. It has to do more broadly with funding for defense of $1.5 trillion. And that's really all that's on the table for the rest of the year, because regular spending will be put off until after the midterms.
Terry, though, is this just normal getting things off your chest? You have one senator saying that luckily nobody got stabbed, Senator John Kennedy, and he was a little nervous that they put out the metal utensils instead of plastic ones. Trump called Senator Cassidy a lunatic, and that was the senator that kept addressing Trump as brother. This feels more than just airing some policy debates.
Well, it's as you all know, it's Cassidy was not supported by Trump and going in to his primary, and indeed lost. The president's made a decision that what they're going to do is do everything possible in the midterms to stoke turnout. They made the judgment. I'm not defending the judgment. I'm just saying they made the judgment that having somebody other than Cassidy in the senatorial seat would, for the election, would drive more turnout. And they've done that in a number of places. Texas, of course, is another one. And so they're focused on that fundamentally. The Senate is a co-equal branch of government. Do I expect Senator Cassidy and other disaffected senators to like any of that? I don't. But, this is a big boy game, too.
Terry, what's going on with the housing bill? Housing was supposed to be a national emergency for this administration. They need to deliver this before the midterm elections. It has bipartisan support in Congress, as Tyler mentioned, yet the president won't sign it.
Well, the housing bill, is bipartisan in Washington is a lot of things. And one way is to get bipartisanship is to make sure that very little gets done. That nobody thinks the housing bill is a panacea or a huge step forward, but it is something that's been hammered out over months. It's something that both parties wanted to do and to run on, and there's kind of two camps in Washington. One camp is, I want to run on a record, so as much as I have on the record of achievement as possible. The other is kind of aspirational, and that's the SAVE Act side of this, where Trump wants to hammer people, wants the SAVE Act. He's not going to get it, but of course that also allows him to stoke turnout and hammer the other side. So. You've got people in Washington that want to run on achievement. They're being denied that. But on the substance, nobody thinks this is a great leap forward. I mean, the Wall Street Journal's been editorializing against it for months.
Terry, who do you think is facing the bigger internal fight heading into the midterm elections, the Republicans or the Democrats?
Well, I don't think I would say the Democrats, but the Democrats aren't really fighting. You've got a situation where the left progressive socialist side of the party, which is where the money and the energy has been for a few years, is basically sweeping centrists away. And that's going to be a big problem for them in the midterms, because it's going to make it a lot harder to go after the 40% or so of undecided voters, or people that don't really care about the ideology. They just want results. Well, the big reason why you end up in kind of this populist world that we're in now is because for the last generation, the establishments in both parties haven't really achieved very much, and people are really, really tired of it. I think the Republicans at the end of the day are going to be quite united, frankly, for a variety of reasons. I mean, they've got redistricting advantages. They've got money advantages. The war ending and oil prices going down, of course, helps them. I think they've largely equalized the turnout advantage. And on top of that, you've got kind of what I called yesterday, pin the tail on the donkey, literally, of who the crazy party is. And by November, what this is going to be about is who the crazy party is. It's probably not going to be the Republicans in a lot of purple states.
Terry Haines, thank you, sir. Terry Haines of Pangaea Policy with the latest. For establishment Democrats, it's Operation Ostrich right now, pretending the New York primaries didn't happen. That's what's sad about the spat with the Republicans in the last 24 hours. This shouldn't have been the headline. Shouldn't have been the headline at all. The headline should have been what happened here in New York.
The truth is that both parties right now are facing a real fight for the heart of that party. And yes, President Trump has taken a lot of that for the Republicans. Underneath, though, a lot of disagreements.
What's hilarious is you have Senate Majority Leader Chuck Schumer saying the election showed a, quote, great unified party. I think it's quite the opposite.
Sure. Coming up on the program, Angelo Zino of CFRA as Micron breathes new life into the AI trade. Snapping a three-day losing streak on the S&P 500. Hopefully, a little bit later this morning. Futures positive by 0.8% following some really strong numbers from Micron. We'll get to that in just a moment. On the Nasdaq, there's your outperformance. You know the why. On the Nasdaq this morning, futures up by 2.2%. Let's turn to the bond market. 2s, 10s and 30s. Nice rally across the curve in yesterday's session. Small bounce back up a single basis point on 10s to 440. Some curve flattening, some bull flattening into this market was a story last week, a story again in the last 24 hours. The flattest yield curve since spring of last year at the close as of yesterday.
Yeah, and this comes as you see a growing willingness, at least perceived, this perception of this in markets, of Fed officials to hike rates in the face of what we're seeing. I go back to what we were talking about yesterday. How much is the equity market and the bond market singing from the same hymnal, given the fact that right now the bond market's pricing in almost 2 full rate hikes for this year, while stock markets continue to move past it? How predicated on the idea that maybe the Fed is all talk and no action? How predicated is the stock market rally on that idea?
Sebastien Page at T. Rowe Price with us about 30 minutes ago. Super bullish, growth stocks in America, super bullish large caps. Said he sounded like Dan Ives, said that repeatedly, and at the same time he's worried about inflation and the prospect of an upset with regards to Fed rate hikes later this year. Can you hold those two thoughts at the same time going into the rest of this year?
If you take a look at flows over the past week, and Bank of America put out a great tracker citing EPFR data, it shows that people withdrew a significant amount from U.S. equities and put a lot of money into U.S. bonds. Right now, people are chasing the income that you can get from bonds when you see yields going up, particularly at the front end. And that is leading to a little bit of a diminishing of the risk appetite around the edges for the high-flying stocks. I mean, does this continue? Is this just a head fake? Does it really matter? We'll continue discussing that.
A break below 420 in the last 24 hours at the front end of the yield curve. Let's get to the move in crude. WTI and Brent wiping out the wartime rally. Just unreal to see WTI back in the 60s. 69 this morning. Brent crude, 72.
We're down some 40% where we had the peak highs when it came to the Iran conflict. And that is because every single day we continue to see good news of vessels actually being able to traverse the Strait of Hormuz. And things are looking like they are slowly getting back to normal. I don't want to be someone who puts just a ton of risk out there, but we have to remember we are in the middle of a 60-day ceasefire. We also need to take stock of where we're going to be the end of August. Does this just continue? Or potentially, if Trump's not getting what he wants, do we go back to some sort of kinetic fighting? At the moment, no one's thinking about post 60 days of
Nobody
the
wants to
ceasefire.
think about that.
So, and the fact of the matter is barrels are moving, and that's good news. Price is down.
Brent crude down by 1.3% this morning. As we count you down to the open, about 3 hours away from the cash open with your morning movers. Yahara has more. Hey, Yahara.
Hi, John. The stakes were high and Micron delivered. Shares are soaring 17.5% in the pre-market after it issued a blockbuster forecast and said that gross margins jumped to nearly 85% last quarter. Its CEO saying that there's still no line of sight to supply catching up with demand. He expects shortages to continue beyond 2027. Another name helping to lift the chip trade this morning is Qualcomm. Shares are soaring 11.5% in the pre-market after the company said that it sees $15 billion in annual AI data center sales by 2029. It's a dramatic shift for a company that made its name in supplying chips for smartphones. Now it's chasing the AI infrastructure boom, saying that Meta will use its new data center processors. And IBM out with some news just in the last few moments. Shares are rising 4.2% in the pre-market after it unveiled what it says is the world's tiniest AI chip technology, a new sub-1 nanometer design. It's still in the research stage, but the breakthrough could eventually lead to faster, more power-efficient, smaller chips once they become commercially available. John.
Yahara, thank you. That stock has had a great run. We add to that this morning. On our radar this morning, our top story, Micron. Shares surging in pre-market trading. The chip maker's earnings crushing estimates, lifting the tech sector and reigniting the AI rally with demand for memory showing no signs of slowing. That stock is up by almost 18%. Elsewhere, Wall Street's biggest banks boosting dividends after passing the Fed's annual stress test, giving billions back to investors. All 32 banks tested showing they could withstand a hypothetical economic downturn. And finally, President Donald Trump going after big oil.
It's ExxonMobil, it's Chevron, it's Shell, it's BP, it's a lot of them. They're not reducing the prices commensurate with what what's happening. We are doing a big investigation on it.
The president ordering the DOJ to investigate the company, saying gas prices should be $2.25, the national average right now holding just below $4 a barrel.
Look, we talked about this yesterday about how this harkens back to another era under a different president where there was a lot of job hunting of the oil majors. I will say it highlights the shifting alliances and allegiances right now with President Trump and a number of erstwhile allies, whether it's the oil majors who previously were in the White House talking about what's going on in Venezuela, talking about how much they were pumping in the incredible preeminence of U.S. oil markets. Also Trump and Bibi Netanyahu at the same time. Like, there are all these fissures at this moment where it's Operation Get to Midterms, and there are a couple of key components, in part, large part, getting oil prices down.
$4 a barrel, I should say $4 a gallon, before anyone gets too excited. But yeah, big spread between that and the $2.25 the president's after.
I don't think we've seen $2.25 since January of 2019. So we're going way back to where the president is trying to think where gas prices should be. The issue is, of course, is that what you are filling up right now in your car, if you were going out today and filling up your car, is oil that was purchased when the premium was much higher. It takes a little bit longer. There's going to be a supply chain lag. But the fact of the matter is, gasoline prices are still below $4 a gallon. I can't even name on my hands the amount of people who said to me, Trump is going to take out the Biden high of more than $5 a gallon because of the conflict. And we never got there.
Financial literacy to get in the way of a good political argument down in Washington, D.C.
Sorry, I forgot about that.
Regardless of what party they're in.
We've seen repeatedly.
Right.
And it clearly is in bold relief heading into the midterms.
Let's get to that stock story. Micron this morning, shares surging in the pre-market. The company's record earnings, signaling there's more AI growth ahead. Angelo Zino of CFRA raising his price target on the stock to $1,500, writing the breadth of margin expansion showcases that favourable pricing dynamics extend beyond AI-specific applications. Angelo joins us now for more. Angelo, welcome to the programme. The number of the morning, and we talked about it repeatedly already, is 85. 85% margins. Angelo, the question we've got to ask with regards to that is why this stock is still trading at a discount to other names in its industry group.
Yeah, and John, I think the answer to that is nobody believes it in terms of the margin trajectory. And we don't believe it either. I mean, I don't think you can sustain an 85% gross margin for the memory industry for, an X period amount of time or several years out. I do think they can sustain that for the next couple of quarters. I think more importantly, though, is when you kind of look at this company, it has completely changed. I mean, it has been transformative in nature when you look at some of the long-term customer agreements that they've just signed, about 16 of them, the improvement in terms of revenue visibility from that, as well as the free cash flow trajectory. We're looking at north of $200 billion in free cash flow over the next 3 years, and what they're now going to be able to use that free cash flow for, and that's going to be buybacks. And then when you kind of look at the balance sheet of this company, I mean, it's completely changed relative to what we've seen in the past. So even though, at some point that margin trajectory is going to let up, at this point in time, the way we're looking at it is even when you get that rollover, the trough margins are still going to be well above the peak margins that we've seen in prior cycles.
Angelo, does it make sense to you that all of the semiconductor stocks are trading in tandem, that because we saw good results out of Micron, SK Hynix rallied by more than 10%?
So the memory, the memory bucket, yes. I mean, that makes sense to us. I mean, clearly what benefits Micron is also going to benefit SK and Samsung. So to that degree, I think it makes sense. You're going to see similar type of results, I think, from those two. When you start thinking about things maybe from a broader perspective, I do understand the fact that, hey, listen, it is a positive, I think, for the broader semiconductor industry, because if you've got bottlenecks, you've got kind of that. I think the implied view is, hey, listen, this at this point in time now goes into 2028, or at least Micron has kind of given you the thumbs up that that's going to take place. That does, bode well for the overall broader semi-trade.
I guess what I'm getting at is it normal for stocks to go up or down by 20% every single day when people have a different sentiment or a different potential rumor coming out? And the inability to really price a name that has been on an absolute moonshot, that has basically tripled in value and then some over the past 12 months. Yeah. And it just goes to the lack of understanding of this exponential type of growth and how you price it.
Yeah, no, I think you make a fair point. And listen, I think, when people saw the NVIDIA situation over the last 3 years or so. I think people thought that was kind of a one-hit thing and we'd never see it again. And then you kind of look at what Micron's doing here, and it's even more pronounced than what we saw out of NVIDIA, which is just absolutely astonishing. But when you kind of think about just the wild moves that we've seen, I think it's one of those situations where no one wants to get caught holding this thing at the peak of a cycle. And because of that, you've got extreme volatility. I think what you're also you're trying to figure out, or what the street's trying to figure out, is, again, what mid-cycles look like, what does normalized earnings trajectory look like? And because of that, there's just extreme volatility that you're going to see across the entire semiconductor industry, and even more pronounced on the memory side. So I think that's a lot of what's going on at this point in time. So do these wild swings make sense? Not necessarily, but given the uncertainty that's out there, we understand why that's happening.
Angelo, can we get your reaction to their mega margin? Is this the peak of their gross margins?
I don't think it goes much higher than this in terms of gross margins. I do think you kind of level out here in the mid-80s. Again, I think there's some sort of limitation in terms of how far you can go in margins. Maybe there's some surprise quarter here over the next couple of quarters where it goes a little bit higher than that. But as you you look towards maybe a longer-term trajectory, I'd say now, potentially mid-70s look like something that's more realistic in nature, where, again, that's something that I didn't even think would have been possible here 2-3 years ago. So, again, you're looking at potentially peak margins, but when you look at that free cash flow potential, you look at the amount of stock this company can buy back given that free cash flow, and if the stock doesn't go higher, you're potentially looking at them, reducing their share count, let's call it at least 15 to 20% here over the next 2 to 3 years. Again, that provides some sort of gravitational pull to the upside here. So I don't think you necessarily need to see margins go higher. I actually think you can see margins actually level off and pull back from these levels to see the stock to continue to wear.
Do you have an update on the mega fabs that are coming to market? I mean, it's a very local New York story. When can we see that actually start impacting the company?
Yeah, I mean, you're seeing them definitely pour more into the construction side of things here over the next couple of quarters. You're not going to see anything, I'd say, extremely pronounced probably until 2028, late 27 into 2028. So it's going to take time for a lot of these investments to really start showing up in terms of the additional capacity that's out there. And again, another issue and reason why we continue to see this memory bottleneck that's out there. Not to mention, when you kind of think about the complexity of this capacity coming online and what it takes to actually build high bandwidth memory, it soaks up and absorbs so much of that wafer capacity out there that again, we could end up being in this kind of tight environment here well past 2028 in many respects.
Angelo, it's good to catch up. Angelo Zino there of CFRA. Micron up by 18%. Bramo asking about the Kospi. You can have a good fundamental story. You build up leverage around it, contributes to volatility. Check out the Kospi. That's the story in South Korea right now. The domestic investors, not just the international ones. The Kospi this week is still down by about 1%. It's almost flat on the week now. Dropped by 10% on Tuesday. We saw a massive move on Wednesday, up by 3%, up again by 5% again this morning. We've seen wild swings all week.
And there are different kinds of dynamics there in terms of the retail investor, as you've mentioned, that are levered up and have been investing or pulling back, and that creates an even bigger swing every single day. But you just start to wonder, how do you price a story like Micron when it's also Western Digital, it's SanDisk, it's SK Hynix, it's Samsung? Everything is kind of wildly swinging in one direction or another, and all it takes is a discussion of where you're accelerating production in one company that has specific factors. That might have been to compete with China. This might be Micron's 5-year agreements with some of its clients. I mean, how much is bespoke? How much is do they have a moat around this? And how much is commoditized? There just aren't that many companies that actually do it.
The stock this morning up by close to 18%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. In the UK, advisors to Andy Burnham are encouraging the would-be Prime Minister to consider reforming the BOE and breaking up the Treasury. Burnham hasn't laid out his vision for the British economy, but a business lobby group is warning against tax increases. NATO Secretary-General Mark Rutte meeting President Trump in the Oval Office, seeking to ease Trump's frustration over allies' reluctance to support the Iran war.
This president is really doing a huge amount of work to get NATO in better shape. He had a big success last year in The Hague with the 5% spending commitment.
Trump reiterating his disappointment with European allies for not allowing the US use their bases during the Iran war. Shares of IBM jumping in pre-market trading after the company unveiled the world's first sub-1 nanometer chip technology. IBM calling the achievement a, quote, landmark moment in computing, pushing technology beyond the nanometer era to the scale of atoms. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. More from Vonnie in the next hour. Up next on the programme, facing down the inflation squeeze.
Right now, the problem is inflation. This is an American per people that is going to have to contend with ongoing inflationary pressures in core services all the way to food.
Inflation data out a little bit later this morning, 8:30 Eastern Time. Up next, Nela Richardson of ADP. More data this morning, 8:30 Eastern Time. Check it out. PCE, the next read on inflation. Going into a contentious few months building for this Federal Reserve. We'll get jobless claims as well. Look out for that. Apparently the labour market right now, not a problem for this Fed, so we'll move on pretty quickly. Let's see. Equity futures right now in the S&P 500 just about firmer by 0.75%. On the Nasdaq, some massive outperformance, up by 2.2%. Heading into that inflation data, check out yields, 2s, 10s and 30s. 2s this morning, a break of 420 yesterday. We're down to 415 so far today. Under surveillance this morning, facing down the inflation squeeze.
Right now, the problem is inflation. This is an American per people that is going to have to contend with ongoing inflationary pressures in core services all the way to food. There is a lot of breadth under inflation, and who's bearing the challenges of that? Well, it's low and middle income Americans.
So here's the latest this morning. PCE data due out in just under 2 hours' time. Rising costs continuing to outpace wage growth. Nela Richardson of ADP writing inflation continues to weigh so heavily on sentiment. Years of higher prices, even alongside rising wages, have shifted how households experience this economy. Nela joins us now for more. Nela, welcome back to the show. The energy problem, it feels like it's going away, but is the inflation issue here to stay?
Well, it has been part of 5 years of our recent history. And I think that's what's hitting Main Street quite hard. You know, the Wall Street stock market, they can look at today's numbers and project forward. But what consumers are doing is they're looking back to what they could afford a year ago, 2 years ago, maybe even 10 years ago when it comes to housing. And they see that they're not keeping up. The BLS reported that real wages are declining in May, year over year, and from April to May. So the accumulation of these higher prices are really what consumers are trying to absorb. And Jonathan, I'll have to note that the savings rate right now is the lowest it's been since 2008, when people were losing houses in mass and most were underwater. And yet, you know, with a booming stock market, we're at the same level of savings rate. And I think that number in itself shows the pressure that households are under right now.
John was mentioning, Nela, how one thing that people have pointed to is that you're seeing increasing momentum in the U.S. labor market, and wages are starting to pick up at a level where suddenly people might be able to offset the increase in prices. How much is that continuing? How much do you see that as being sort of the ballast behind the inflation story?
Well, at ADP, we're a payroll company, so we see that wages have been steady. They've been holding for job stayers at around 4.5%. That's fantastic in terms of the level. But Lisa, again, it's about the accumulation. The job increases that most people experience are not enough to combat 5 years of rising prices at the clip that we've seen them rise over the last 5 years. And prices are always rising. We always know that. Wages generally keep up, but absorbing them is becoming harder and harder. And I think that's what's the disconnect here. Yes, wage growth is pretty robust and the labor market is fairly stable. In fact, it's probably one of the most stable labor markets in U.S. history. I'll even go out on the limb and say that. And yet it's the inflation picture, that backdrop is still eroding the confidence that you see in workers because they can't keep up.
Nela, if that's the case, are you saying that it's not possible for this level of inflation to be sustainable and that ultimately, especially with savings running dry, people are going to start to push back a little bit more? You're going to see more demand destruction?
Yes, and I think that's already occurring. Look, Lisa, one of the ways that people actually increase their wages to keep up with inflation is by changing jobs. But if the labor market is it's steady, but in some ways very stagnant, you're not seeing a lot of hiring, you're not seeing a lot of turnover, that means there's less opportunity to actually get that pay bump by changing a job. So what do you do next? Well, that goes back to your budget. What can you afford? What can you cut? Maybe it's that vacation. But it is a change in how people are experiencing the economy, even if their wages are going up. And that's the important part. They may have a job, they may see wage increases. It's still not enough if the overall economy is becoming more and more expensive.
Nela, with a little bit of heat taking off of gasoline prices, do consumers save that, or are they just going out and spending that elsewhere?
Maybe some can save that. Maybe some can save what the gas price is filling up the tank. But my suspicion is those funds will be diverted to where else we're seeing higher inflation. I'm a little disheartened by higher rental costs, for example. That was supposed to be going down over the last year. We're seeing a pickup in those fees. So there's plenty of places to put that gas savings, and we're not sure that energy prices are out of the woods yet. So there's a little bit of uncertainty of how long lower gas prices will last.
And Nela, do you think the Fed has a role to play here?
Yeah, they always have a role to play when it comes to inflation. That role is to maintain price stability, as everyone at the Fed is very laser focused on. But the question, the transmission mechanism, Jonathan, is generally through the housing market. And that's where the Fed doesn't have the strength of the toolkit that they used to, because there's not a lot of inventory. There's not a lot of home buying. The average age of a new home buyer back when I was a housing economist was in their early 30s. Now that I'm focused on the labor market, it's early 40s. And so people are not experiencing that low interest rate or housing environment or wealth accumulation for another decade than they used to. And I think that has an effect on Fed policy and its transmission in the Main Street.
Nela, it's good to see you. Really thoughtful stuff, as always. Nela Richardson there of ADP, heading into PCE data later this morning at 8:30 against the backdrop of a debate around the Federal Reserve potentially hiking later this year.
Yeah, and you ask a good question, which is essentially what is the mechanism that a Fed rate hike will have in bringing down inflation in areas that might be somewhat independent of those rates? How many people do we talk to that say that these companies are going to keep spending on all of the different AI-related capex, regardless of whether interest rates are 25 or 50 basis points higher?
As we know, housing is supply constrained, but supply constrained for many reasons, including the lock-in that some people have, the golden handcuffs of a 2-3% mortgage.
Yeah, I don't understand. Yeah.
And the lack of building in certain markets too.
Yeah, no, look, this is true. And some people did get in with low interest rates, and those people are not moving, and the rest of the world is suffering the consequences.
What can the Fed do about that? That's the issue I've got with all this.
I mean, they could raise rates significantly, torpedo growth prospects, lower long-end interest rates, and
sink the long end.
Boom.
Getting some of that flattening at the moment.
Not quite that extreme.
Just a little bit. Equity futures right now up by 0.75%. Up next, we'll catch up with the bullish Ohsung Kwon of Wells Fargo, alongside Gardner of Stifel, Heath of Citi, Meghan Swiber of Bank of America.
What we all know is that earnings estimates continue to rip higher.
2026 earnings are going to be okay.
The chip names have done a great deal of the heavy lifting.
If we see a broadening, that would be a healthy sign in this market.
We think there's probably more weakness coming through the summer months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures on the S&P on track to snap a 3-day losing streak. On the S&P 500, up by 0.8%. On the Nasdaq 100, up by 2.3. Thank you, Micron. In the pre-market, thank you, 85% margins and absolutely crushing estimates. That stock is up by 18% in the pre-market. Heading into this, the rate debate. The tech trade is fine based on this so far this morning. Later this morning, 8:30 Eastern Time, PCE setting up the rate debate at the Federal Reserve.
How much is inflation coming from other inputs other than oil? How much is this independent of what the Fed can do? How much is this dependent on the AI trade? And how much does this depend on people being able to buy Hermes and Ferragamo ties? At a certain point, you look at all of this and you start wondering how much we are looking at an overheated economy that the Fed can do something about, and will they be willing to, given that they have a lot of task forces discussing all of these things?
The U.S. consumer, according to Paul Donovan, and maybe that's individuals that have been on the show or anchor the show, have shown an impressive determination to keep shopping throughout the tariff and oil price shocks. And we have actually seen individuals just look through the tariff price shock. And now the oil issue is becoming so much easier. We are erasing the highs we had before the start of this conflict.
This is Paul Smith on the sale.
Oh, yeah?
Just for the record.
Is it tailored?
No, this is not.
Oh, wow.
No.
I think it's going to. This is a Thursday tie. I'm not saying
Why are you
anything.
going after me this morning?
I'm not going after anyone. I was just saying that, you look at the high-end goods, they tend to be increasing at a faster pace, and that's boosting inflation.
You got to get on
all
wait
around.
lists these days to get some of these high-end goods.
Don't throw stones if you're sitting there in Balmain, all right? Equity futures right now in the S&P up by 0.8%. Coming up this hour, Ohsung Kwon of Wells Fargo after boosting his outlook for stocks. Heath of Citi as Micron's blowout earnings ease AI concerns, and Meghan Swiber of Bank of America, her team calling for 3 rate hikes later this year. We begin this out with stocks rebounding after Micron's results reignited enthusiasm for this tech trade. Ohsung Kwon of Wells Fargo raising his year-end price target for the S&P from 7,300 to 7,950, writing sentiment has reset, providing room for upside in the AI trade. We continue to prefer CapEx takers over spenders. Ohsung joins us now for more. Ohsung, good morning. My word's not yours, but is that Micron over Meta, Micron over Microsoft?
Yeah, no, it's semis over hyperscalers, basically. So CapEx takers over CapEx spenders. We have this funny chart that shows the relative performance of CapEx growers. So if you were to go long top 50 stocks in the S&P by CapEx growth and rebalance each month, you would have just underperformed almost every month. Meaning the market hates, stocks that are in an investment cycle, which are basically hyperscalers today. So I think the easy trade still is to own AI infra, semis, and some of the construction companies and power, things like that, over hyperscalers.
When does the overspend inform the spending? When is the pushback by investors? You say investors hate it, but the stocks, the companies keep doing it. Yeah. When does it stop them? When do they look at this and say, you know what, it's time to pull back?
I think it's way too early for that. I mean, we have seen this movie before, right? During Q4 last year, the market started pushing back on hyperscalers CapEx. They didn't care. The market is pushing back now. They don't care. They're actually raising equity. I think it's way too early for that. I think as long as demand, token demand and compute demand overall outpaces supply, which is the case right now, I think they're going to continue to invest.
One of our listeners put this Micron CEO quote at me from the conference call that I thought was pretty amazing. Our customers are recognizing that supply shortages in memory and storage will take considerable time to improve. We currently do not have a line of sight as to when memory supply will be able to catch up with increasing demand. The idea of what some of these companies are able to charge is mind-blowing. How do you even begin to price in what the valuation of a company like that is, given the fact that maybe over the next 5 years they can have 85% margins, but in 10 years there'll be another Micron and another one that will be flooding the zone with supply?
Yeah, I mean, it's going to be very difficult to value these companies. The thing is, if you look at multiples, they're not expensive. They're actually cheaper than where it was about a year ago. So it's really driven by profits, and these profits, as we saw last night, it's still very, very strong. I mean, that's really why we're bullish on equities overall and why we upgraded our S&P target. It's really because of profits. So we were basically neutral about 2 to 3 weeks before we turned bullish again last week. And the reason why we were neutral was because sentiment was euphoric and there was inflation concern. Sentiment has now reset. Our sentiment indicator is actually firmly neutral. Inflation risk, oil is down to 60s. So I think inflation concern is going to subside as well. That's why we turn bullish.
I want to pick up on that. Is oil prices declining enough to offset the inflation that we're seeing, say, in memory chips or other components related to the AI build-out and other people who are earning maybe some of the payouts to go from Google, say, to Anthropic, and then they can pay for whatever they want?
Yeah, I mean, for the overall economy, memory prices and some of the inflationary pressure that we're seeing from the build-up isn't that much. It's really the consumer and what they see when they fill up their gas tank or when they go grocery shopping. And with oil down to $60, 60s, I think the inflationary pressure is going to subside over the next 2 months, and that's going to alleviate some of the concerns for the macro cycle.
But you don't think they save it? They actually go out and spend it, the consumer?
Yeah, I mean, the savings rate is pretty low, and they're going to continue to spend on the economy. And we highlighted 2 tailwinds that not many people or actually nobody's talking about for the second half of the year. One of which is the tariff refund. So we were skeptical too that the refunds were actually going to go out. But over the past month, there was $25 billion of checks being issued to the importers. And total collected under IEEPA was $165 billion, which is about 50 basis points of GDP. So if that actually goes out to companies, and during the Q1 earnings season, about 40 companies talked about tariff refund, and 8 companies actually recognize it as earnings. So I think as we move into the second quarter earnings season, I think more companies are going to be talking about it, and I think that's going to boost EPS even more.
What's the other tailwind that no one's talking about?
It's Trump accounts. So starting in July, Trump accounts will be open, and people can fund their kids' Trump accounts, and the government is going to subsidize about $1,000 for each kid born from 2025. And we estimate about $20 billion of equity inflows just from Trump accounts. And that $20 billion is going to be price-insensitive flows that happen mostly in July and August, concentrated in U.S. equities, really large caps. So it's going to benefit tech over others, but it's going to be a pretty sizable tailwind for the overall market.
So they're the tailwinds. Let's talk about some pushback. So this came from JP Morgan, who also raised their price target on the S&P 500, but acknowledged the following. We've reset the bar higher, heading into earnings season again, making it more difficult for companies to significantly surprise to the upside. The takeaway seems to be that things are so good, they can't get better. Mm-hmm. Where do you stand on that?
I mean, I think the bar has been risen, but historically, when we actually see EPS getting revised up into earnings, companies actually tend to beat. So the earnings momentum, it typically continues, and I think Q2 earnings season, I think companies are going to beat even the higher bar. And I think that's going to continue to push the market higher.
Do you think that broadens out beyond the obvious places?
I think so. Yeah, I do think the market's going to broaden out a little bit. We still prefer semis and AI infra over others. So we were actually more in the camp that things are going to broaden out more meaningfully before the Fed. And the Fed sounded a little more hawkish than what we had initially expected. And I think that is a headwind to the broadening trade, not necessarily to the index, but more for broadening. So I do think it's a headwind, but cyclicals have some catch up to do. So I think the market is going to broaden out a little bit, but not as much as what we had expected before.
Sounds like this is another example of the bond market thinking that rate hikes are in the coffer, and equity analysts saying, no way, no how, you guys are just wrong. Is that correct?
The way we interpret the bond market into the equity market is, I think it matters more for the breadth of the market rather than the index level. As long as they're not necessarily hiking this year, I think the market is actually going to do well. Our house view is that they're actually going to be on hold. So if that actually plays out, then I think the market's going to be okay. And even the hiking cycle is not that bad. I mean, I think, I forget the exact stat, but during the tech bubble, I think it took, like 150 basis points of hike before the tech bubble actually popped. So, it lasted through the hiking cycle during the tech bubble. And, I think 1 or 2 hikes is going to be okay.
This is just fascinating to me, John. We heard this yesterday from Darryl Kroc, I know from the same company. So there is definitely this house call about no hikes. But still, I find this really interesting. It's sort of usually you think of the bond market as the smart money and the stock market as the dumb money. In this case, it's the stock market saying you guys are fooling yourselves if you don't see what's happening with oil, if you don't see what's happening in some of these other disinflationary inputs. And frankly, what's happening politically. This isn't a Fed that's going to hike.
I think we are having that debate in fixed income, though. Of the rate strategists that are coming on, there is a debate right now about whether this switch up at the Fed is a change in style or a change in substance. Is it a change in policy or how we communicate policy? And we'll spend the next few months trying to figure this out.
If you believe that it's a change in style and not substance, and you think that actually what they're going to end up doing is, well, if you think that they're going to end up keeping things on hold, then you buy the front end of the yield curve. And we've seen a little bit of that over the past couple of days because people are saying, hold on a second, maybe this has gone too far.
Ohsung, good to see you.
Good to see you.
79.50 on the S&P 500 year-end. New price target over at Wells Fargo. Ohsung, Kwon. Equity futures are right now positive by 0.7% on the S&P. Massive outperformance on the NASDAQ by more than 2% so far this morning. Let's give an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump kicking off the United States' 250th birthday celebration with a rally-style speech on the National Mall. The speech is the first of many events in the administration's Freedom 250 programming that will stretch over 16 days. Anthropic accusing Alibaba of trying to illicitly access its AI models. Sources telling us here at Bloomberg, Alibaba used nearly 25,000 fake accounts and nearly 30 million message exchanges with its chatbot Claude, targeting its most prized capabilities. Qualcomm shares rising in the pre-market. The company forecasting sales of more than $15 billion a year by fiscal 2029, thanks to the booming market for AI components and data centers. And tune into BTEC at 11 a.m. for Ed Ludlow's interview with Qualcomm CEO Cristiano Amon. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, the President calling out big oil.
ExxonMobil, it's Chevron, it's Shell, it's BP. They're not reducing the prices. We are doing a big investigation on it.
Who does that sound like? Up next on the programme, Brian Gardner of Stifel, live from New York City this morning. Good morning. Micron higher by 18%, around those levels throughout much of this morning, up 18.5 right now. That's lending itself to this move right here. Across the board, equities higher on the S&P, on the NASDAQ, up by 2.2%. In the bond market, things stabilise going into PCE a little bit later. Yields on the front end of the curve, two's around 4.15, contributing to that move, this move in crude. Check it out. It's just crazy to see this down in the 60s. WTI at 69, Brent crude at 72.
So you have two things going on. More barrels moving through the Strait of Hormuz. Secretary Wright yesterday actually talked about 72 ships, 20 million barrels transited through the Strait. Also, did you see this? Iraq are reporting potentially maybe going to leave OPEC because they want to hit higher quotas. This is the UAE effect, and you can start to see more countries saying, look, the UAE left. They're getting as much product out as they want. Why do we need to be beholden to the kingdom? We're going to go too.
There's an old saying in financial markets that if you want to make a fool out of someone, ask them for a forecast of crude, right? That's been the story the last 3 months.
People underestimated how much supply-demand dynamics would adjust, how much demand would come out of the market coming from places like China. And right now, the market's getting flooded with barrels. Some of the anecdotal stories of the calls inbound about, hey, want to buy my oil, gives you a sense of how the demand dynamics haven't changed as quickly as the supply dynamics seem to be adjusting.
It's such a strange first half of the year. The first quarter felt like a lifetime. Second quarter, gone.
Absolutely. And you look at what the main driving narrative has been. I mean, we've been through tariffs, we've been through rebates, we've been through this question of the Strait of Hormuz, we've been through AI, we've been through the bust, we've been through
Started the year with the
Maduro?
capturing of Nicolas Maduro,
I mean,
who's sitting in a jail just a few miles south of us.
Wild.
At the halfway point of the year, I think half of Wall Street ready to retire. Let's talk about energy. Under surveillance this morning, the president calling out big oil.
We are not seeing anything at the pump by comparison to what it should be. We should be, in my opinion, at $2.25. ExxonMobil, it's Chevron, it's Shell, it's BP. They're not reducing the prices commensurate with what's happening. We are doing a big investigation on it.
So here's the latest this morning. The president ordering the DOJ to look into oil companies, saying gas prices should be $2.25, the national average holding just below $4. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, this is really underscoring the mounting frustration from President Trump about how higher costs are becoming a political liability as we head into the midterms, now alleging anti-competitive behavior. Though the industry has pointed out that gasoline prices don't adjust immediately to changes in crude because the effect has to move through the supply chain and it can take weeks to get from pipelines to processing to distribution. Plus, local gas station operators see their margins shrink when there are quick climbs in the wholesale costs, which typically means that they are more inclined to lower their prices gradually when they're setting those final prices at the pump. Now, we did get a response from the industry, according to the American Petroleum Institute, which represents many of these companies. They said in part in a statement, quote, "Our industry shares the goal of delivering relief at the pump and restoring stability to global energy markets." Now, President Trump isn't alone in his criticism. This is very reminiscent of the bid by the Biden administration to investigate these big oil companies amid the price spikes related to the conflict in Ukraine. But, John, this feels very notable considering that the Trump administration is considered to be very aligned with the oil industry when it comes to collaborating on the president's push for more domestic drilling and his domestic energy agenda. Bloomberg News did report in April that the U.S. Energy Secretary and Interior Secretary called up these executives directly and asked them to try to boost supplies in a bid to bring down costs.
Tyler Kendall with the latest. Tyler, thank you. Brian Gardner of Stifel writing the following. After the midterms, the president will have less incentive to not blow things up. The chances for political volatility and chaos are rising. Brian, we called out the financial illiteracy of the left, of the senator of Massachusetts, of the Biden White House when they said these kind of things. Why are we seeing it from the Republican White House now as well going into the midterms?
This is what you get in a populist era of politics that we're in, Jonathan. It's playing to the public in ways that you don't see in normal times. So, we're going into this midterm election, and the president does feel the pressure on prices, on affordability, and he's trying to push on whatever levers. Now, I think we got to take a step back because there have been similar threats throughout, right? We go back to January. You're just talking about how the first quarter, seemed like a long time ago. Well, in the first quarter, he was threatening caps on interest rates of credit card companies and banks. And so that never came to pass. So I think we need to take some of this, the threats against the oil companies with a large grain of salt. But he does feel emboldened to go out and going into his last 2 years, he's not going to be restrained by normal political factors. So I think we're going to see more actions by the White House where he wants to impose a legacy. So there's going to be chaos and volatility in the future.
Brian, I was traveling with the president a few weeks ago, and I asked him if he felt like it's odd to be on the same side of some policies like Senator Bernie Sanders. And he said, actually, on economics, sometimes they do align. Are you saying we're going to see more of that after the midterms?
I think the chances are high that, yes, we will. Don't forget, let's go back. I'll give you another example. After the November elections, with the election of the new mayor in New York, the two of them met and had a fairly cordial conversation. As somebody observed, game sees game. So the president and Mayor Mandami see in each other that populist tendency, those populist qualities, how they play to the public at large, and an angry public. What does the public want? They know how to play on that to advance their political agendas.
Yeah, I think yesterday he called Mayor Mamdani handsome or good-looking dude that's charismatic. At the same time, he's having a massive fight with his own party when he went to the GOP steering lunch. Are we going to see more of this kind of Real Housewives of D.C. kind of blow-up meetings going into the midterm election?
I think, yes. I mean, it's kind of head-scratching to the political class and to Republican strategists because it does wind up inflicting self-imposed wounds, self-inflicted wounds. It does not help Republicans going into the midterms. Voters are going to be voting on as a referendum on the president and the president's party. And what this does is it makes them look ineffective, confused, chaotic. And voters don't want that. I think there's been a clear message throughout the last couple of cycles. voters are discontent, they're unhappy, but they also want stability. That's why they went with Biden in 2020. That's why they went with Trump in 2024, because they didn't think that Biden fulfilled that. And Trump was going to be somewhat more normal and controlled, but then compared to Biden, and what are we getting? We're not getting that. And the voters are not getting that. And so I think all of this is just against the president's political interests and his party's political interests.
Right. And maybe voters want that at large. But with the primary system, what you get at a lot of the different, whether it's Democrat or whether it's Republican, the more extreme candidates, I just wonder how much we can expect an acceleration of that in the midterm elections, given what we've seen in the New York elections recently, and more broadly, just sort of this populist wave that's gaining traction.
It's not just a populist wave, but it's an era where the voting electorate of the two parties are big chunks of them are sitting out. So we talk about populism, we talk about the extreme candidates that are being nominated in the primary system. Well, 75 to 80% of each party sits out at primary. So people will bemoan the lack of moderation, of centrism. Well, if you want centrism, you got to go out and vote and in order to beat the wings. The two wings are dominating the primary processes, and the center is sitting it out. So that's why we're in the position that we're in.
What do you think that means for policy? I mean, what should people on Wall Street be watching in terms of policy shifts? Is it AI restriction? Is it when it comes to the housing market, this one aspect of it right now in limbo, but still the institutional investors won't have the ability to play in this market as much? I mean, how much is this going to actually make its way into policy?
I think there are limits on how much it makes its way into policy. I mean, I ticked off a couple of examples of some Trump proposals from early in the year that did not happen. The rhetoric around antitrust was quite heightened after the 2024 election. We thought we were going to get kind of an extension of the Biden antitrust policy. That didn't happen. I think Washington is kind of in a position where everybody kind of sings the same song, but not maybe from the same hymnal. They're singing a tune, but not the same words. So there's going to be talk about AI restrictions. There's going to be talk about affordability, as there has been, but getting to an agreement on how to address that, there's a big gap between the two parties, despite the fact that the president and Bernie Sanders and Elizabeth Warren will agree with each other from time to time. Getting them in a room and actually hammering out a deal is much more difficult. So I think the market kind of sees that. They see the lack of progress and productivity coming out of Washington and just chalk this all up to political rhetoric and political grandstanding. And that's why I don't think we've seen a follow-through from the political rhetoric into the market so far.
Brian, it's good to see you. It's always great to catch up. Brian Gardner there of Stifel. In many ways, this set the tone for the start of the year. Do you remember capping interest rates on credit cards? You've brought up housing, restricting investing in housing. That set the tone, really, at the start of the year.
Yeah, what's actually gotten through, though? And I think this is important, right? How much is this jawboning, whether it's calling out Exxon? Well, he's no friends of Darren Woods, right? We've seen that time and time again. Chevron, et cetera. Is this sort of jawboning to try to say, look, I'm doing something. Check this out. I'm doing something on affordability rather than an actual policy prescription.
Do you remember in early January, there was a phone call between President Trump and Elizabeth Warren, and it was about capping credit card interest rates?
Yeah.
Stunning.
That set the tone for the year. But to your point, not much got done.
I love the idea of humming along to the same hymnal, but having different words. It sounds like my family trying to sing along to a song.
What is the latest, Kaz Abramo? What's the latest fight? I haven't shared one of them for a while.
It's been a lot of joy recently. It's
okay,
end of
beautiful.
year.
Come
people
by
are
out.
ready for the summer.
Everyone's bullish.
Going out late, so I don't see them.
Terrifying. Three-day losing streak on the S&P 500, about to snap that later on this morning, with equities pushing higher on the S&P by 0.6, on the Nasdaq 100 by 2 full percentage points off the back of some stunning numbers from Micron. We'll spend some time on that in just a moment. 2s, 10s and 30s in the bond market going into PCE data later on this morning look like this. 415 on 2s, 10s around 440, a drop back from 450. Nice rally just yesterday. We get a little bit later this morning. Just bear in mind, once you've got CPI and PPI, Wall Street has a pretty good idea of what PCE will look like.
And if the Wall Street estimates are correct, we're going to get 4.1% year over year core PCE acceleration, which would be the highest or the fastest pace going back to April of 2023. That's the bad news. The good news is some people will argue that is going to decelerate from here because of oil prices going down. Is it? That is the big debate right now on Wall Street.
We are committed to 2%. Inflation is a choice. All the kind of things you're hearing from the new Federal Reserve Chair, Kevin Warsh. Does that mean they need to hike to get from 4 down to 2?
I have to ask the task force, because right now the task force is examining whether that is the correct metric to use and whether that actually overweights some of the components coming from AI that could potentially not be as sticky and, frankly, be less relevant to what the Fed policy rate is.
But also, the Fed might be in a position to punt this a little bit. We just had a resolution in terms of a 60-day ceasefire and oil prices coming down. What's going to be baked into this PC is obviously when oil prices, gasoline prices, diesel, et cetera, were much higher. Where are we going to be at the end of the summer?
We're getting a helping hand right now, at least from energy. Check it out. Brent and WTI declining once again. Brent this morning, 73, down about 1%, just off the lows of the session. WTI in the 60s, at 69 at 80, and down by 0.8% so far this morning.
The barrels are moving, and demand structurally may be permanently diminished. I keep thinking about what Dan Striven said yesterday of Goldman Sachs, that the level of shift that you saw over in China to electric vehicles, even in Europe, has been stunning and rapid, and that the increase in oil consumption just isn't there in the same kind of way as a result of the structural demand destruction that you've seen.
Without the shift in China, the stockpiling too, that China went through over the last year, so they could pull back on imports, pull back on refining as well. Without that, they have a different story. They really helped out.
Oh, absolutely. China came to the rescue of the global economy, almost came to the rescue of this administration. They buy the lion's share of Iranian crude. Maybe the administration was willing to forego any issues in the past they've had with China. I imagine this came up at their conversation in Beijing, because without China doing this, you would have seen prices much higher.
A full round trip on crude, a volatile one, an exhausting one in many ways for everyone. 2 hours away from the cash open. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. The bar was high and Micron more than cleared it. Shares are rising 17.5% in the pre-market after it issued a blockbuster forecast saying that margins jumped nearly 85% last quarter. Its CEO saying that there's still no line of sight to supply catching up with demand, and he sees shortages remaining beyond 2027. Also helping to lift the chip trade this morning is Qualcomm. Shares are rising 10.2% after saying it expects nearly $15 billion in AI data center revenue by 2029. It's a dramatic shift for a company that made its name supplying chips to smartphones. Now it's chasing the AI infrastructure boom. And we end on Alibaba, those ADRs falling nearly 3% in the pre-market after Anthropic accused the Chinese tech giant of illicitly accessing its Claude AI model despite its best efforts to try and keep that out of China, showing how far, if the allegations are true, showing how far companies are willing to go to access those leading models. John?
Yahara, thank you. Thank you for the update. On our radar this morning, our top story, then Micron shares surging in the pre-market. The chip maker delivering blowout earnings with a gross margin of 85%. Micron's results easing concerns around AI-fueled growth. Elsewhere, as Yahara suggested, Anthropic accusing Alibaba of launching a large-scale effort to, quote, illicitly access Claude with the use of nearly 25,000 fraudulent accounts. Anthropic seeking additional government support to counter unfair practices by Chinese rivals. And finally, Google expecting to lose 2 of its AI researchers to rival Anthropic. Sources telling us here at Bloomberg the staffers are key contributors to Google's Gemini. Their exits are the latest in a series of high-profile departures.
So I did spend some time trying to find out how much Jonas Adler and Alexander Pritzel were being paid to leave Google and go to Anthropic, which is, of course, the operator of Claude. Couldn't find it. I'm guessing quite a bit. Right
it's
now,
like
the
baseball contract money.
Probably
right before
beyond,
an IPO.
because ultimately this is probably the key existential race. And if you think that Micron can see insatiable demand. Right now, every single tech company has insatiable demand for talent that can give them the next best thing. That can get them the leg up for the most expensive models. And right now, you have to wonder how much this is contributing to some of the underperformance of some of these names, whether it's Google, whether it's Meta, whether it's Amazon, or even Microsoft. It is difficult for them to retain talent when they cannot promise the kind of moonshot from an IPO and the shares that they might receive that you would get if you go to the likes of Anthropic.
Signal Fire, a venture capital capital firm did a study last year, and this is what they found. Deep mine engineers are nearly 11 times more likely to leave for Anthropic than the reverse. Is this even awkward a little bit for Alphabet, given the fact that they compete, but they're also a partner as well when it comes to Google and Alphabet? I imagine right now, before the IPO, this is where you'd want to get in.
Wouldn't you rather be that kind of rich, like rich and no one really knows your name, as opposed to rich and everyone knows who you are?
Yes, that's.
I mean,
right?
that's
These guys
living
get
the
paid
dream.
like
Is that
tens,
really a
hundreds of millions
question?
of dollars.
I mean,
no,
yeah.
some people want to be famous, Bramo. I just don't, I'm not interested in any of that. If I could earn that kind of money and no one knew who I was, amazing.
I'm not that picky. Whatever you want to throw at me, that's good. I'm glad.
You can sit courtside in the Knicks. You could sit front row at World Cup. No one knows you're there.
The camera. I hate that about the World Cup, by the way. Since you bring that up, the celebrity cam. What's that about? I don't care. I don't care who's in the stadium.
Are you not entertained, John? I thought we went over this yesterday.
I don't need that to entertain me.
I like the
Welcome to
celebrity
America.
cam. I like the celebrity cam.
See?
When
Why?
it's,
There
when
you
it's
go.
on Mike Bloomberg, get to see who he's sitting.
Okay, that's different. That's the
Courtside
boss.
Knicks.
All right, of course, that's different. Love the celeb cam. Let's turn back to our top story this morning. Micron shares surging on its blockbuster forecast. Heath Terry of Citi Research writing the health of the AI trade will continue to be defined by the irresistible force of enterprise demand, meeting the immovable object of inference capacity. Heath joins us now for more. Heath, good morning. Good to see you.
Yeah, good morning.
Let's pick up on that enterprise demand. Just how robust is that right now?
Look, it's incredibly robust. We'll get Q2 numbers in a few weeks, but if you look at what we've seen over the last few quarters, we've gone from 28% year-over-year growth in Q1 of last year to 33% in Q2 to 53% in Q3 to 91% to 141% in Q1 of this year. Like that kind of bend in the S curve that we're seeing here, and we believe it's going to accelerate again in Q2. That's the best proxy for what's happening in enterprise demand. And anybody who works at a Fortune 500 type company that is pushing this into production can tell you they're seeing it in real time.
There is a rush to build out capacity to meet all this demand. Yeah. Some companies are benefiting more than others. Micron with 85% margins. Other companies that are doing a lot of the spending right now are being punished. Their stocks are being punished. This is a thing we keep bringing up. Do you think that changes the trajectory for spending?
Look, no, I mean, not anytime soon, because the companies are getting real returns on this. The market right now is not giving the companies that are spending on this, the hyperscalers, the kind of credit that they normally would for a couple of different reasons. But the biggest one is there is this gap between when you have to start spending and building all of this out and when you actually start seeing the returns on it. If you look at cash return on cash invested, which we believe is sort of the best gauge of the returns that they're actually generating on this, the hyperscalers are generating 29% returns on this investment. Very stable. It was 29% in Q1. It was 29% in Q4. If you have the ability to borrow at 6% or to issue equity and get a 29% return on it, you're supposed to do that, regardless of what your stock price is doing. And while the stock prices aren't doing what Micron's stock price is doing, they're hanging in there enough that investors haven't rejected this, right? Google issued $85 billion worth of equities. The market didn't really blink.
Well, just to build on what John is talking about, maybe people are still lending and they're still able to raise cash. Nonetheless, it's getting a little bit hairy for the likes of Microsoft, down 18% for this worst monthly performance going back to 2008. You see Oracle down more than 30%. Are we starting to see the beginnings of investor pushback that maybe hasn't put teeth in this trade by withdrawing cash, but certainly has put a little bit of notice around that capital?
Well, the thing that we have to remember, particularly when it comes to Microsoft and Oracle, is those are both software companies. Look at everything else in software and what those stocks have done. The market's not responding negatively to the acceleration in growth that you're seeing at Azure, the returns you're seeing at Azure. It's responding to the other 70% of Microsoft's business that is software. It's responding to the biggest part of Oracle's business, which is software. And so I think that's that, if anything, should encourage more investment in this area, particularly as we start to see the acceleration in Azure revenues through the end of this year, which we believe the market will respond positively to.
We've seen this rolling ball of cash, and as we heard from Sebastien Page earlier, everyone's looking for the choke points. Yeah. The next place where you're going to see things just sort of shoot exponentially higher because of this insatiable demand and a limited supply. After memory, what's next? I mean, do you have your eye on kind of those choke points?
I mean, we do. I mean, the choke points sort of exist throughout the supply chain right now. Memory is obviously the biggest one. Anthropic told you that very loudly a few weeks ago when they raised their most recent round. They had the opportunity to choose strategic partners. They could have picked anyone they wanted. They chose three: Samsung, Micron, and Hynix. And so, like, if anyone who's surprised by what's happening with Micron today and what's been happening with high bandwidth memory didn't pay attention to what Anthropic told them. The next point after that is it's at interconnect, it's in storage, it's in labor in a very big way, and of course it's in power. We've been talking about that for so long. It's also, because of what you see with Micron, it's very much in semi-cap equipment because we do have to make more memory, we do have to make more chips, we need more compute, we need more storage and memory.
Do you think some of these companies along the supply chain, we could potentially see these issues emerge later in the year or next year as they build this out, are undervalued right now?
Well, I mean, so we've been saying this like from maybe I started at Citi a year ago. The first thing that we said is you want to be where the bottlenecks are, and that has continued to be the case, and we sort of stuck with that. That you have, this is where pricing goes. You were talking about sort of the underperformance of the hyperscalers. You want to be where people are spending money, not necessarily with the people who are spending the money, and so that's going to continue to be the case. We would argue it's not even so much undervalued; it's just estimates are too low. Consensus numbers aren't high enough because the amount of infrastructure that is going to get built, the amount of pricing increases that you're going to see, that, you know, irresistible demand, immovable supply, the only thing that breaks in that is price. You saw it in the Micron number, 85% gross margins. Memory companies are not supposed to have 85% gross margins. Eventually that will settle out because that's what cyclicals do, but we're a long way away from that happening.
You said that one of the choke points was in labor. Are you talking about Jonas Adler, or are you talking about Dave, who constructs some of what we're seeing with the hyperscaler buildings?
So it's certainly both. There is not a lot of talent out there that has the capability of advancing these models the way that level of sort of the Jonas Adlers of the world do. I have no idea. Okay, but I mean, if you look at some of the stuff that was announced last summer, right, when Meta was doing these deals, right, Anthropic is doing these deals now, Meta was doing them last summer, it was 6, and in some cases, you know, I mean, it was you know, very large sort of, you know, in some cases, billion-dollar kind of pay packages over multi years. And when you look at sort of the acquisition hires that many companies have done, it falls into that hundreds of millions and beyond kind of level. That said, what I was referring to is very much, it's the electricians, the plumbers, the construction people that actually have to build these data centers. There are very few people in the world that have the skills to be able to build at the level that these data centers require. And those people are in massive demand right now. And deservedly, they're getting paid a lot more too.
Yes.
Yeah.
And that's the takeaway here.
Yeah, no, it really, I think that I need to give some new recommendations to my children.
Heath, it's good to see you. Thanks for being here.
Thanks for having me.
Breaking it down, just a real clinic there for us. Heath Terry of Citi Research. I think that's the second time so far this morning. Basically, the takeaway is the runway is longer than you think it is when it comes to a lot of these themes.
Micron kind of threw that in everyone's face overnight. I mean, the idea that we could see that kind of gains, and the rhetoric coming out of the company saying, we have no idea when the demand is going to start to fade, because right now, it's just to the moon.
Micron this morning, up by close to 18%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. OpenAI unveiling its first custom AI chip developed in partnership with Broadcom. So far, the chip, called Jalapeno, is showing cost savings of roughly 50% and will be integrated into large data centers from OpenAI backer Microsoft and other partners. Cerebrus share is falling to the lowest since its IPO in Wednesday trading following the company's earnings. Cerebrus' annual revenue forecast falling short of analysts' expectations. The reaction underscoring the sky-high expectations for AI chip companies. In sports, South Africa qualifying for the knockout stage of the World Cup for the first time after beating South Korea 1-0. Switzerland edging past Canada to finish in the top of Group B, and Brazil beating Scotland 3-0. Tonight it's Team USA facing Turkey in its final group stage match. And that is your Bloomberg Brief. John.
Vonnie, thank you. The Tartan Army, just the winners of the World Cup so far. Sad it's not really worked out, but just fantastic to see what those fans have done in the northeast of this country.
It's been fantastic. I mean, honestly, I love the spirit that we have brought. I mean, all of the fans have been pretty awesome.
It's pretty cool, right?
Yeah.
I like the Norwegian rowers.
Yeah, the Norwegian rowers, I was going to say.
Amazing.
You know, the Scots are pretty wild. You've got, of course, the Brazilian yellow army that seems to be going around
in
the country.
Miami.
Yeah, I mean, be everywhere. It's
they're
been
having
fun.
a good time too.
Yeah.
All right. Up next on the program, the Fed's hawkish tilt.
We don't think the Fed and Chair Walsh are going to be able to raise interest rates like the bond market is priced in. It's part of Chair Walsh establishing his independence, new sheriff in town.
Up next, we'll catch up with Meghan Swiber of Bank of America. Bank of America looking for 3 hikes this year. The AI trade upended for about 3 days, and not even that really. This morning, equity futures up by 0.6% on the S&P, up by 2 percentage points on the Nasdaq. Micron in the pre-market is absolutely flying. The coverage will continue right here on Bloomberg TV. Micron up by 18% in early trading. So the tech trade is doing okay. What about the rate hike debate? 2s right now. 10s, 30s in the bond market look like this. 2s around 4.16, yields picking up just a bit, up a basis point. Going into PCE data later on this morning. Under surveillance this morning, the Fed's hawkish tilt.
We don't think the Fed and Chair Walsh are going to be able to raise interest rates like the bond market is priced in. One time is just symbolic. It doesn't do anything really for monetary policy. It's part of Chair Walsh establishing his independence, new sheriff in town.
So here's the latest this morning. PCE data due out in just less than an hour's time. Rising inflation expected to reinforce bets the Federal Reserve will raise rates in the coming months. The team at Bank of America calling for 3 hikes this year. Meghan Swiber writing, Walsh is a Fed chair who wants to be actionable. The task forces are not a tool to buy time, but a tool to get things done. We think the market can price in a higher probability of a July hike. Meghan joins us now for more. Meghan, good morning.
Good morning.
This is the debate on this programme right now, style versus substance. You don't just think this is style, you think this is substance. There's a shift here.
We think that this is substance, John. And what was really shocking to the market, not so much us, because we were on more of the hawkish side of the equation, coming into the meeting last week, was just Walsh's commitment to bring inflation back down to 2%. And this notion that the Fed has been missing on this mandate for not just 1 or 2 years, but 5 years. We get the PCE data this morning. PCE is really where the problem sits, not so much CPI, certainly not inflation expectations if you're looking at market pricing. And this is what the Fed has to acknowledge. They still have this very firm commitment to 2% PCE. And the data this morning, we think, will warrant a Fed that's going to have to hike rates sooner and get out from behind this problem that's been persisting for 5 years.
And to your point, not just hike once,
not just
twice,
once.
3 times
Three
this
times.
year. How well priced is that story?
It's not well priced, we think. And my sense talking to a lot of clients, a lot of investors on this, is that there's still a very big contingent that do not think that Walsh will deliver hikes at all. And that really comes from more of this inertia that we've seen the market trade with over the past year, that Trump was going to appoint someone to the Fed who was just going to blindly be able to cut rates. We also have this global dynamic going on as we see hikes getting taken out of European curve, gilt curve. And that's because those hikes were very much more so predicated on the inflation coming from oil. This is not the case in the U.S., where we have much more strength coming from core numbers, coming from services inflation. And that really is what underpins our conviction that the Fed is going to hike here.
What about the task forces? Don't they have to get started?
I don't think, Lisa, that they're going to wait until we see the conclusions of these task forces to actually action anything. We actually take a very different notion than I think many in the market who have been looking at this task force mandate and saying that this is just a way for Walsh to buy himself some time. He's going to rethink what the inflation mandate looks like. He's going to think more differently about what data to look at, think more about Fed communication. We think that that is just another signal that Walsh is someone who wants to step in there and get the job done. And if he can get in there, do 75 basis points of hikes, reverse what the Fed did last year in terms of those insurance cuts that we saw, it gets the Fed back to a better place where they can say, we've delivered now on this inflation mandate, and then we can cut rates back down to wherever they think neutral is.
What do you think will be the trigger in terms of the data that we're going to be getting, not just today, but over the next few weeks, that will allow the Fed to actually take action as soon as July?
Lisa, I think it just has to be similar to what we've been seeing in recent months. Break-even payrolls creation, everyone has been thinking is very, very low. Payrolls numbers on a 3-month average basis have been, more than double, close to triple what many economists were expecting in terms of what that break-even number is. We see another strong payrolls print. That's a go sign for us from the Fed. It's also, of course, going to come down to the inflation data. And a big issue here that we get pushed back on is certainly in coming months, month over month, CPI, PCE is going to be negative on a headline basis. But what the market's got to very quickly then do is take the CPI data, as it has been doing, and trying to imply what that means for PCE. And we'll get the data this morning, but it does seem to us like it's going to be a signal that the Fed needs to get out from behind the curve.
How many hikes are you expecting before the midterm election?
Well, we're expecting the Fed to go in September, October, so ultimately 50 basis points. It's not really, in our view, this importance of midterms. It's this acknowledgement of the issue for voters more broadly, that inflation has been one of the key leading issues around consumer sentiment.
Yep.
Everyone knows that. The Fed knows that, and they need to get their credibility back.
The White House would like long rates down, not just short rates.
Yep.
Long rates are coming in relative to the move we're seeing
yes, John.
in twos. When you sit with the team right now, how does your outlook for short rates inform your outlook for long rates?
So it's quite different right now. When we think about curve moves, everyone on our team is much more so in this flattener camp. I actually just recommended a trade this morning to actually implement this flattener trade in real yields versus nominals, because if we do see the Fed getting out from behind the curve on inflation, there's actually more room that inflation compensation, the way the market prices that, can decline. And we do see in periods of time where the Fed is hiking to offset these inflationary pressures, real yield curve can invert. So for us, it's more of a story that front-end rates are moving higher versus 10-year rates. If the market takes this Fed messaging as they're going to get in there, they're going to quickly hike, then it allows them to get back to neutral in later years. It may actually result in a twist flattening of the curve, where you have front-end rates moving higher and 10-year and out rates moving lower.
Thoughtful stuff. Meghan, thank you. Meghan Swiber there of Bank of America. We've seen that flattening come into this market.
Yeah, not though with real yields. Just to pick up on what Meghan was talking about, right now 10-year real yields are about 2.2%. They're close to that high point level that we saw back in 2023 of 2.5%. You could argue this is part of what we're seeing with the wobbles going on in some of the risk assets. If you start to see that come in and you get that curve flattening to potentially get to that inversion, that's fascinating. It gives you a sense of how the Fed might be thinking about this too, actually.
Something to look for going into year-end, potentially, and over the next few months. The task force, not just a talking shop, not just designed to delay time, at least in the opinion, the view of Bank of America, designed to get things done.
If this president wants to get rates lower, and he's talking about 10-year yields, then this might be the only way to do it, is to potentially hike rates in the front end.
Did Besant allude to that this week?
Yeah.
Kinda.
Yeah, howitzer.
Kinda. Coming up, Liz Ann Sonders of Charles Schwab, the former New York Fed President Bill Dudley, Stephanie Roth of Wolfe Research, Darius Dow of 42 Macro, all of that in the third hour of Bloomberg Surveillance, just around the corner. It's up next.
Right now, the problem is inflation.
We've been flagging the breadth of inflationary pressures for some time.
The FOMC has to be particularly attentive to its mandate around price stability.
The economy is going to strengthen. Inflation probably is going to slow down.
Our view is that we're going to see peak rates and peak inflation in the second quarter of this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores. The price action looks like this. Equity futures up by 0.6% on the S&P 500, up by 2% on the Nasdaq. Thanks to this move, Micron in the pre-market flying all morning, up by 17% so far. And the outlook for stocks apparently is getting better and better. We've had upgrades to price targets of Wells Fargo, at Barclays, at JP Morgan. Now SocGen taking its S&P 500 target to 8K.
What's fascinating is you haven't seen participation in some of the biggest names out there. You've seen some of the biggest hyperscalers actually losing tremendous value over the past month, even as you see the equal weight outperforming up 1%. You have the likes of Microsoft down 18%, Oracle down 30%, Google down 8% so far in June. Nonetheless, people are looking at the rotation, people are looking at the profits, people are looking at Micron and the other semiconductors, Western Digital, et cetera. And they're saying, you know what, there still is upside here because it is real. And if you doubt that it's real, take a look at Micron earnings and weep, because ultimately it is delivering in the 85% margins.
That's the tech trade. Let's get to the bank story. Check out JP Morgan in the pre-market. These headlines just crossing the Bloomberg terminal. There was a time right before Lloyd Blankfein steps aside that a race started between two co-presidents. Going into that, JP Morgan making a similar announcement, Lisa, this morning.
Yeah, Doug Petno and Troy Rohrbaugh are named co-presidents, and Marianne Lake has decided to retire. What we're hearing is that Troy Rohrbaugh will be the CEO of Consumer and Community Banking. What we see from Doug Petno is he's going to be CEO of Commercial and in the Investment Bank. This comes, of course, as people are thinking about the succession of Jamie Dimon as CEO. There have been a number of people who have been elevated. Right now, we have to imagine that Doug Petno and Troy Rohrbaugh are squarely in the lead to overtake that C-suite position.
At least you know the bank well. Typically, when you speak to Jamie Dimon, we've all seen him ask the question repeatedly, how much longer? He will say 5 years. 5 years. After those headlines, what do you think the response would be this morning?
You know, he's already moved back from that. He said he still has a lot of leeway. Of course, there is also a question of whether he could remain chairman while a new CEO comes in, because right now Jamie Dimon is chair and CEO. We have seen a number of other banks take moves to create a succession plan and then get the person in place over the past couple of years. The speculation is going to be very hot, especially because these two individuals were pegged as likely successors in the past, along with a few others. It seems like the crew is narrowing down.
And the move from Marianne Lake kind of speaks for itself, doesn't it?
She's not going to be it, and that is what people are going to assume.
JP Morgan in the pre-market up by about 1/3 of 1%. More details on that for you when we get them. Coming up this hour, we'll catch up with Sonders at Charles Schwab with the AI trade bouncing back. The former New York Fed President Bill Dudley on the risk behind the Fed chair's new playbook. Stephanie Roth of Wolfe Research reacting to the latest inflation data. That inflation data about 26 minutes away. We just had a conversation around the table about 3 hikes this year with Bank of America. They're looking for those hikes to start maybe as soon as July.
And that would follow core PCE coming in what is expected to be 4.1%, the hottest level, the fastest pace of acceleration going back to April of 2023.
Let's begin this out with stocks gaining after Micron earnings sparked a new wave of momentum for the tech trade. Sonders at Charles Schwab noting there is same bus risk from enormous concentration in narrow cluster of semis, hyperscalers and memory chip makers. Lisanne joins us now for more. And Lisanne, whenever you get the jitters, everyone wants off the bus. And then you get a rally on a stock like Micron, everyone wants off again. How concerned are people out there about being in the same trade?
Well, I think many of the cohorts, institutional cohorts that play off of each other's positioning, systematics, long-short hedge fund community, the commodity trading advisors, and then I would put the retail trader in the mix too. And they are playing actually crowded trades and looking to potentially press some shorts. And that is really short attention span money moving rapidly. And that's why you're seeing these incredible rotations under the surface. And it's now happening at that sub-sector, even sub-industry level. And I think that kind of backdrop in this environment of short-termism with narratives that can change really quickly, or you get an earnings report like we did last night, and it's just rapid-fire movement of money.
Lisanne, when it comes to the fundamentals, and I know lots of leverage has been built up around the fundamentals, but let's focus on the fundamentals. We're asking the question, look at the spenders, they're under pressure. Meta, Microsoft, those stocks are in bear markets. When do they pull back on the capex? And the takeaway, the reaction we've had this morning, Lisanne, is ultimately this runway for this spending is longer than you think it is. These themes can carry on. There's a lot of oxygen still left up here. Do you see it quite the same way?
I do. I think the runway is long for spending based on the demand side of the equation. I think what we're starting to face now, though, are constraints as it relates to inputs and costs. And at the corporate level, the sort of utilizers of AI and the spenders on AI from an enterprise standpoint, you're now finding that there's starting to be a little bit of a pushback because costs have gone up so much. In fact, you guys know Rick Wurster, our CEO. He and I had an interesting email exchange last week, talking about in some cases now there's the reassessment of the cost of human capital, maybe in relative terms, looking somewhat inexpensive. So I think that's the stage we're in right now.
Lizanne, how do you view the hyperscalers that are being beaten up as they are the spenders on all of this CapEx that seems to be just ever growing?
They're the dull new objects. If you look at a cohort like the Magnificent Seven, those stocks from a price performance standpoint, the best performer, which is Alphabet, isn't even in the top 200 of S&P 500 performance. And when you talk about contribution to return, because you have the multiplier of their extremely large cap size, you don't even have any of the 7 in the top 10 in terms of contribution to return. And I think there's finally an awakening to this shift in focus away from those early players of the AI trade. It's still embedded in a lot of the concentration that exists in portfolios, but you're starting to see increased pressure because of that desire to rotate into more attractive areas.
And it's more attractive areas in whether it's the memory chips or other areas that are supply constrained that are related to the tech trade. But it's beyond that also to the concept of the efficiencies that are built from AI and others. I'm just wondering how much the broadening out trade hinges on the Fed remaining on hold, on inflation going back down, on the acceleration that we expect later today to be the peak of where we are in terms of price increases.
So I think the market has embedded in its expectations now that the Fed is at best on hold, and obviously the market pricing in hikes. And you do see some rotation to take advantage of where there's sort of more or less correlation to the rate cycle. It's also the case, though, that this broadening out is not just within the AI space. It's more broadly within the market. Part of the reason why the Russell 2000 is so handily outperforming the S&P is because it's got exposure in areas like healthcare and biotech. And I think that that's an interesting story that's being less told right now. Over the last year, it's single-digit percentage of S&P stocks that have outperformed the index itself. Over the past months, it's 60% of S&P stocks have outperformed the index itself. You've had these down days where you've had positive breadth. I think that's an interesting story that's getting told under the surface of these cap-weighted indexes.
Lizanne, though, what kind of stock market could we see if we get the 3 hikes that Bank of America just told us they're expecting 2 before the midterm election in November?
I think the market would probably have to go through a digestion phase if it is 3 hikes. I think that there's still sort of this hope that the inflation fighting credibility that Kevin Warsh obviously expressed, that may be enough to restrain things. And if you see some volatility in the market, you can see financial conditions tighten in a way that maybe takes a little bit of that pressure off the Fed. But notwithstanding a different look to the Fed under Kevin Warsh, the bottom line is they're still data dependent. So with every data point that we get in, more so on the inflation side of the dual mandate, maybe a little bit less on the labor market side, unless you get an extreme move in the labor market, either toward the positive or toward the negative. I think those expectations around Fed policy are going to continue to jump around.
Lizanne, just to wrap things up, on the disconnect between crude and what's happened with rates, what's your reaction been to that? And does it complicate the broadening out story?
I think there may be something to the notion that even though the move significantly higher in oil prices did not cause a major strain on the economy, I think there's validity to the idea that maybe lower oil, lower gas prices in an environment where consumers still obviously want to spend, that could provide a little bit of boost to the economy, which could in turn exacerbate the inflation problem. Not to mention the fact that there are inflation feeders that are not just oil. AI is an inflation story. Money supply is an inflation story. So I think that's what's getting built into expectations here.
Lizanne, appreciate your time as always. Lizanne Sonders of Charles Schwab joining us on the rates market on equities going into PCE data in about 20 minutes' time.
Yeah, and a real key question here is how much has the market already baked in the expectation of true rate hikes on the heels of what a lot of people are expecting is incredibly hot? core PCE.
Let's get you an update on stories elsewhere this morning. Some breaking news crossing just moments ago. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Yep, a change at the top of JP Morgan. The bank announcing Troy Rohrbaugh and Doug Petno, the co-CEOs of the Commercial and Investment Bank, will become co-presidents of the company effective immediately. Marianne Lake, currently CEO of the Consumer and Community Bank, is retiring after more than 25 years with the company. President Donald Trump criticizing big oil, accusing firms of overcharging consumers.
Gasoline prices should be much lower at the pump. And the oil companies are possibly gouging. I hope they're not, otherwise they're going to be in big trouble. They're going to be in big trouble. We're not going to play games.
The president ordering the DOJ to investigate the company, saying gas should be $2.25 a gallon, not $4, which is currently the national average. Ares' flagship private credit fund capping redemptions at 5% again. The fund saw requests to withdraw more than 14% of shares outstanding as of April 30th. The announcement follows similar moves in the private credit market. And that is your Bloomberg Brief.
Hey, Vonnie, thank you. Appreciate the update. Let's get to JP Morgan in the pre-market. Check it out. Not seeing a big move here. We're up by about 0.1%. But I think you're seeing a big development in the C-suite and the future leadership of this company.
Yeah, it had been 5 people who had been elevated, and it seemed to have been some sort of race, and people wanted to sort of try out for the job in real time. Now we have a whittling down, and it seems like there are 2 people left, Doug Petno and Troy Rohrbaugh, who both are being elevated to be co-presidents of JP Morgan. This is what the race is. Mariana Lake, who has been with JP Morgan for more than 25 years, will retire, according to the statement. A really key question in the succession race at the U.S.'s biggest bank.
Are we down to 2? We've played this game quite a few times. It certainly feels like we're down to 2.
It feels like we're down to 2, and I think that this is the suggestion. I mean, unless there's some kind of sleeping dark horse in the corner, which I'm sure that if you talk to any of these individuals, they'll say, look, we're not going to get complacent. We also are just going to rise to the occasion and not focus on it day to day, et cetera, even if somebody's trying to, kind of wiggle it.
We'll come back to that story a little bit later this morning. Up next, we'll get you some morning calls. Plus, we'll catch up with the former New York Fed President, Bill Dudley, on why Fed Chair Kevin Warsh shouldn't let markets call the shots. Live from New York City this morning. Good morning.
The choke points sort of exist throughout the supply chain right now. Memory is obviously the biggest one. Anthropic told you that very loudly a few weeks ago. They had the opportunity to choose strategic partners. They could have picked anyone they wanted. They chose 3, Samsung, Micron, and Haines. Anyone who's surprised by what's happening with Micron today and what's been happening with high bandwidth memory didn't pay attention to what Anthropic told them.
There are many people surprised. Evidenced by the move in Micron this morning. So clearly many people weren't paying attention. That was Heath Terry of Citi. Myself included, maybe. Equity futures this morning on the S&P 500 up by 0.6%, on the Nasdaq up by 2 percentage points. We'll get to Micron in just a moment. Just wanted to pick up on another developing story, just getting those breaking headlines moments ago. On JP Morgan, a shake-up in the C-suite. 2 co-presidents, stock is up by 0.5%. This will get people talking on Wall Street about getting closer to that moment for Jamie Dimon to depart.
Yeah, and does he depart as chair and CEO, et cetera, et cetera? Does it matter? Either way, Doug Petno and Troy Rohrbaugh squarely in the hot seat in a competition for who is going to be the next CEO. I'm sure the speculation will continue that the race is now down to 2, and that if the race is down to 2, they're getting closer to some sort of succession.
Gets awkward quickly. Saw this with Schwartz, saw this with Solomon at the time. Harvey Schwartz, David Solomon over at Goldman Sachs under Lloyd Blankfein. That didn't last too long.
That you have to pick one and then the other one leaves, typically, because either you're going to be the CEO or you're going to go to greener pastures. The fact that we saw one of the individuals who was named as a potential successor, Marianne Lake, drop out gives that suggestion that now it is being whittled down. But yes, it does get awkward. So this can only last so long.
Stock is up by 0.5%. The other name, of course, the name driving price action this morning, the number one is Micron. Micron having a massive session so far, going into the opening bell. That stock is up so far this morning by 17%. Let's get you some morning calls with one stock in focus, Micron. First up, Melius doubling its price target to a street high 2,200 after the company shattered earnings expectations. Your second call from JP Morgan nearly tripling its price target, saying the company's multi-year customer deals mark a fundamental transformation. And your third and final call from Baird, more than doubling its price target, saying the customer agreements provide visibility to multiple expansion. They weren't paying attention either.
I mean, honestly, It seems like paying attention isn't good enough. You need to be able to price out an exponential type of progression, and everyone knows that's very difficult to do.
Just a fantastic move on that name so far this morning. Let's turn back to the Fed, because in 12 minutes' time, we'll be talking about inflation. Chair Kevin Warsh making changes at the central bank, limited forward guidance, creating task forces and putting even more weight on signals from financial markets. The former New York Fed president, Bill Dudley, weighing in, writing this: a fresh look is appropriate, but this needs to be done with greater care than Warsh has shown to date. Bill joins us now for more. Bill, welcome to the show. It's nice to reflect on these kind of things with you, so thanks for being with us. What are you reflecting on right now? What are you concerned about as this comes together?
What I'm concerned about is that I'm perfectly fine with getting rid of forward guidance. But what I'm concerned about is Warsh is not disclosing what his monetary policy reaction function is. In other words, how would the Fed adjust policy as the economic environment changes? And I think that's a big mistake. The idea that you can rely on financial markets to tell you what you should do in terms of monetary policy, that won't work, because markets price to what they think the Fed will do. So if the Fed's looking at the markets and the markets are looking at the Fed, how is policy actually set? It's really important in the United States that markets understand how the Fed's going to react, because monetary policy works mainly through financial conditions, the effect of short-term rates on bonds, stocks, credit spreads, the dollar. So if the markets don't understand what the Fed is doing, those markets aren't going to be priced appropriately relative to what the Fed is actually going to do. And that's going to both slow down the transmission of monetary policy to the real economy, but it's also going to make it less efficient. So it seems to me like you got to provide more guidance about how you're actually going to react if things evolve differently than you anticipate.
To your point, Bill, I think you're picking up on a tension we all witnessed in the news conference. He seemed to find it difficult to separate forward guidance from communicating, articulating a reaction function. Where do you think that came from? Why is that difficult? Do you think it's straightforward?
I think it's straightforward. I mean, I think forward guidance is really basically saying, here's what we expect to do next. The monetary policy reaction function isn't about what we're going to do next. It's about how we would react to different sorts of incoming information. So I think he needs to distinguish between those two things. Right now, I don't really understand how he expects to set monetary policy. The job of monetary policy is the Fed's job, not the market's job. And so the Fed needs to do its job.
Part of his argument, perhaps just being generous, might be that there are task forces for that. And essentially, they have to understand what data they're looking at before they understand exactly how they should react. Do you buy that argument?
Well, obviously, it makes sense to take a fresh look at what data is available. But at the end of the day, these task forces have a finite life. I mean, the Fed has basically got to conduct monetary policy, not just over the next 6 months, but over the next number of years. So I think the reliance on task forces, maybe it buys him some time to think about what he really wants to do. But at the end of the day, these task forces are not a replacement for the Fed communicating about how it's going to act as economic conditions change.
Right now, Bill, when you take a look at the inflation rate, when you take a look at the oil input, but also the broadening as we're seeing it in PCE, which we're going to get in about 9 minutes' time, do you think it is appropriate for them to hike at least once, if not twice or 3 times this year?
Well, I think that the case for monetary policy becoming a bit tighter is pretty compelling to me for 2 reasons. Number one, we've been at this level of rates or higher for 3 years, and the economy is still at a 4.3% unemployment rate. So what's the evidence that monetary policy is restrictive? And second, financial conditions are really accommodative. The board has a model of financial conditions, and right now it shows the impulse to growth over the next year is over 1% positive on GDP growth. That's the highest since late 2001, early 2022. So I think that easy financial conditions, no evidence that monetary policy is restrictive at a time that you've missed your target for more than 5 years, does create a strong argument for tightening monetary policy. I'm aligned with Alberto Musil, Lori Logan, but what I think doesn't really matter. It's really what Kevin Warsh is ultimately going to do. One thing that's going to help a little bit in his, in giving him a little bit more time is this is probably the last bad headline inflation report we're going to have for a while, because because with the decline in oil prices, when we get the inflation data for June, headline inflation at both the CPI and PCE level is going to decline quite significantly.
But what about the housing market? Isn't it still fair to say what we have is highly restrictive for housing?
Well, I think housing is not doing well for a couple reasons. The main reason, though, is lack of demand because we don't have any labor force growth. So if you don't have labor force growth, you don't have household formation. If you don't have household formation, you don't have a lot of demand for houses. There's also an affordability issue in terms of what level of income you have to achieve to be able to buy a house. But I don't think, you look at mortgage rates, our mortgage rates particularly high. I mean, they're high relative to the last 15 years or so. But if you go back prior to the great financial crisis, mortgage rates in the 6.5% range, no one would view that as particularly high.
Well, it is high, though, if you're sitting on a 3% rate and you refuse to move because then it doesn't offer up a lot more housing for everyone else.
Well, there's a lock-in effect that people are, deciding not to move because they don't want to lose the advantage of those very low mortgage rates. But if they move, they're demanding another house. So I'm not sure that, that really is going to have a big effect on housing affordability. The big question, I think, for housing affordability is what can you do about zoning? What can you do about land use to basically allow more homes to actually be produced? Increasing the supply of housing would then weigh on housing prices, and that would make housing more affordable. But I don't think it's really a big interest rate problem, frankly.
Bill, just a final thread, a few questions. Just on this institution, you've worked at it a long time from your position at the New York Fed, going down to Washington on so many occasions. How easy is it to change this institution?
Well, there's certainly a lot of inertia in the sense that you have staff that are going to be there a lot longer than Kevin Warsh is going to be there, for example. And the staff has a lot of pride in their work, and deservedly so, because they have a tremendous amount of expertise. But you can definitely move things if you have a better mousetrap. When I went down to the New York Fed after the second day I was president of the New York Fed, I basically said, my mantra is best idea wins. The best idea that people come up with should actually dominate, regardless of where it comes from. And I think the board staff, the staffs of the Federal Reserve Banks really subscribe to that. So if Kevin Warsh and the task forces come up with better ideas, I think those best ideas will actually win.
Bill, it's good to see you. It always is. Thank you, sir. Former New York Fed President Bill Dudley on this Federal Reserve. Going to get this inflation print in about 5 minutes' time. And as Bill pointed out, this could be the worst one. And then we move on to better prints in the months ahead, given this move in energy.
Better is a relative term, though, especially when we're talking about the highest inflation going back to April of 2023. And would that be enough? I mean, I'm thinking about Bill Dudley being sympathetic with the Lori Logans of the world saying, and the Beth Hammocks of the world saying he would be in favor of tightening policy. Does it matter what Kevin Warsh thinks if a number of the committee members are in favor of, say, raising rates as soon as July, like Bank of America thinks?
I'm hoping to be talking about threes and not fours, but threes are still a problem.
Yeah, but this is the point, is that we haven't seen it come down, and it is accelerating in a number of different places.
And we are looking for a four handle in just a moment on PCE year over year. That break in inflation data just around the corner. Stephanie Roth of Wolfe Research joins us to break it down. That data a few minutes away. The up in about 60 minutes away. The data is 20 seconds away. Equity futures on the S&P 500 positive by 0.6. On the Nasdaq, some real outperformance. The Nasdaq 100 up by 2 percentage points. In the bond market, we won't be talking about Micron. We'll be talking about PCE in just a moment. Yields up by a single basis point. The 2-year around 4.15. Up a basis point or two on 10s to 4.41. With the economic data, let's cross over to Enda Karen for more. Enda, that data about to cross any moment now.
Yep, so we're seeing a fall in personal spending, but on the core PCE index on month, up 0.3%. John, that's in line. And the headline basis on month, up 0.4%, just a touch below expectations. So looking on the monthly numbers for PCE, either coming in line or a touch below, perhaps hinting at not as bad a story as some concerned. But nonetheless, these numbers do confirm that PCE, which is the Fed's preferred inflation gauge, remains well above where they want it to be, well above their target. We know some of this story is down to airline fares, to portfolio fees, its import costs, and healthcare costs have been part of it. We'll have to break down the detail as we go. But these numbers, as I say to you, more or less in line, but certainly not where the Fed would want them to be, and it leans into this new hawkish narrative that we have.
Expectations matter. Small downside surprise on headline, opening the door to this move at the front end of the yield curve. Yields were pushing just a little bit higher by a basis point. Now they're dropping by about 2 basis points to the front end of the curve. Check it out. Two's down by 2 to 3 basis points at the moment. So back down to 412. In the last few days, we were looking at 420, so that's a real repricing at the front end of the curve. Yields down. That unlocks this move at the equity market level. Equity futures pushing higher once again, up by 0.8% now on the S&P 500, up by 2.4 on the Nasdaq 100. An early move, as we often say on this programme, not always the right one, but this is the early move off the back of this small downside surprise on PCE.
Yeah, people were worried that potentially it could show signs of acceleration. We really have to dig into the details to understand where some of the inflationary inputs are. Just to give the exact numbers, 3.4% core PCE on a year-over-year basis. That would be the highest since November of 2023. The headline PCE price index coming in at 4.1%. That's the highest going back to April of 2023. Again, it matters the components. How much of this is going to fade? And can that give you true relief that the Fed can look past this, even though we still are way above that 2% target?
And the 4 is bad, 3's not great. But is this as bad as it gets, looking out through the summer now, given the developments we're seeing in energy?
Well, that is the big question, John. So, to your point, these numbers are for May. It's ahead of the Iran deal, whatever one's views on that are. If that energy story holds and plays out, we're obviously going to see wild swings on headline inflation, and obviously that will trickle through the inflation story. But nonetheless, these numbers where we are right here, right now, are probably the reason why Fed officials are looking at PCE with a 3 handle by the end of the year. Even if the energy story holds together, will it be enough to get PCE, back below 3 and heading towards its target? That remains a big ask, John, because it's not just energy. Remember, there's the AI story, there are pockets of services inflation, and there's the rental disinflation story, which hasn't gone away. So I think right here, right now, the inflation story remains an open book, leaning towards the hawkish side of the debate.
Andrew, it's good to see you. It always is. Thank you, sir. Enda Curran of Bloomberg News down in Washington, D.C. Good to see personal income and personal spending coming stronger than expected as well. We better even talk about jobless claims at 8:30 on a Thursday morning these days, because you can guess where jobless claims are. 215. I'm not even looking. What are we? 215. I looked. 225. The right kind of downside surprise.
Yeah, you must have looked, but at the same time, you would be forgiven for just assuming that it was right around there, and that is coming down. Again, you're not seeing signs of that. The fact that personal income, just to sort of reiterate what you were just saying, John, coming in hotter than expected at 0.7% versus 0.4%, gives you a sense that maybe there is heat under the market. I mean, there are a lot of ways to read this. The components really matter.
Equity futures up by 0.8. On the Nasdaq, we're up by 2.3%. Let's get to the details. Stephanie Roth of Wolfe Research joins us around the table. Stephanie, good morning.
Good morning.
You've had a chance to look at the details. How bad is this? How much better is it than expected?
I mean, I think it's certainly better to see that your core PCE number came in lighter than I would say, even though it met consensus. There were many out there that feared it would be rounding up closer to 0.4%, which was a legitimate risk. So if you look at core PCE inflation, it came in at 0.32. There were many that were thinking it would come in above that 0.35, which would push it up to 0.4. So I think that's some of the market's reaction, because it was, I guess, the worst case scenario would have been avoided. Now, the question, of course, is on a go-forward basis, what are we going to see in terms of the inflation data? Now, much of the impact on core is not really related to the Iran war. It's not really related to energy prices. It's been a combination of lingering tariff effects, AI, importantly, and then, of course, you have the Iran war. So the next couple of months, are you going to see a notable disinflation? You kind of need to see core PCE running 0.2 or below for the Fed to feel more comfortable in this environment.
So, Stephanie, this is important because we've noticed the same thing in financial markets, a disconnect between the move in crude and the move in interest rates. And what you can see is a massive round trip on crude, wiping out all the wartime gains. And yields at the front end of the curve are still higher by 70 basis points relative to where they were at the end of February before this war started. There is a belief this Fed still hikes, even if this inflation data improves from the 4s down to the 3s. Do you see it the same way?
Yeah, I think we're in an environment where there's not that much time for the Fed to be able to feel comfortable about the inflation path. And Chair Warsh last week kind of set the stage for, we'll see what happens in 6 weeks. Is the data going to be better enough in 6 weeks for them to feel better? And again, maybe in September. So our base case is that the Fed will ultimately stay on hold and it'll be the markets doing the work. But the path has gotten a lot narrower for that. You really need to see all of the inflation prints, surprise to the downside from here. You need to see a bit of a rising unemployment rate, as you often do in the summer. But if every single data point doesn't fall in line, then the Fed is going to go.
Is this a sign that the Fed is actually easy on the monetary policy, that not only is the rate not restrictive, but it actually is accommodative in the face of the build out of AI? Or do you think that this is exogenous factors that are creeping in or that are just 1-2 punches, whether it's the tariffs or whether it's the oil prices or whether it's some of the AI inputs?
If the Fed hikes 1 or 2 times, even 3 times, that's not going to impact the AI trade, right? AI is still going to be an important force for the economy. So it's a lot of, I guess, to your point, it's somewhat exogenous factors that don't really rely on, the level of interest rates so precisely. It doesn't really matter because the ROI on this investment is so much higher than the current level of interest rate that it doesn't really matter. These projects are going to get done, the investment's going to happen, and growth is going to be quite solid. And then, of course, you were talking earlier on the show, housing is still an issue, but it's a relatively small part of the economy, and everything else is running relatively firm.
So can we make any conclusions about the Fed's policy rate and its influence over the inflation? Or right now, are these two kind of diverse from each other? Are they kind of speaking to another era that has become obsolete, kind of in support of these task forces that are going to reassess exactly what the role is of this institution?
Yeah, I mean, interest rates still matter. So to the extent that it matters for financial conditions, if they end up following through with the couple of rates hikes that are priced in, let's say they even do 2, that would at least match what market's pricing, and that could sort of keep financial conditions stable. They don't really want to be easing financial conditions in this environment. So surprising in a dovish way at this point could just fuel some additional inflationary pressure, specifically coming from risk assets. But that said, rates are not that restrictive for most of the economy, but some of it just has to kind of run its course. The AI stuff is sort of a short-term trend that is very important, and eventually it will be disinflationary. At the moment, it is inflationary.
How weak would the labor market have to be for the Fed either to stay on hold or consider maybe even bringing up a cut?
So in order for them to stay on hold, I think you need to see, 4.4 over the summer, maybe 4.5 on the unemployment rate. For them to be considering a cut, I think it needs to be notably higher than that, and then seeing signs of disinflationary. Core PCE running, in the notably below 0.2%, and the unemployment rate really starting to head significantly higher, and payroll surprise to the downside. Now, this is the whole big story to get to a place where they're cutting. It's a really difficult story to tell how they actually get to those cuts. But it would be an environment where the labor market surprises in a meaningful way. And it's kind of hard to see that momentum deteriorate so quickly.
Bill Dudley was with us 15 minutes ago. Bill reacted the same way many people did to the news conference. Why did the new Fed chair find it difficult to draw a distinction between offering forward guidance and articulating the reaction function of the committee?
I think he didn't want to make any promises. He also didn't want to commit to hikes, especially at the first meeting. But it was interesting that Trump, during that meeting, made the comment about whatever that they're doing, whatever they are doing in this meeting, and maybe they'll hike rates. It doesn't really matter. So it was interesting to see that he backed off, because that was a big argument many people were making for Warsh coming in and being a more dovish chair.
But he didn't back off yesterday. The president literally said, low interest rates will solve everything. Get the interest rates down.
But he at least he didn't attack Warsh in that moment. Of course, he's still always going to be a low interest rate guy. But the fact that in the first meeting he didn't start the path of going after Warsh is notable, because that at least separates the two. He's always going to want low interest rates. And, eventually maybe they can get there, but this is not the environment for that.
We saw the same thing from the Treasury Secretary, that's for sure, earlier this week at the Economic Club in New York event here in New York City. Stephanie, it's good to see you. Thanks for being here.
Thanks for having
Stephanie
me.
Roth there of Wolfe Research. Following this data, the preferred read on inflation for the Federal Reserve, at least for now, because that might change later in the summer. PCE coming in at the strongest level going back to 2023, spring of 23.
Yeah.
April to be precise.
So right now I'm looking at some of the components under PCE and what actually was the acceleration. Services came in pretty hot, contributing a significant portion of that, also non-durable goods. So when you take a look at this, it doesn't look like this is as much directly related to oil prices as other factors. This is sort of the spreading out, the broadening out in services side inflation that has the likes of Austin Goolsbee concerned. And you see that in a lot of this data.
Speaking of higher prices, this from Apple. The team just breaking the numbers for us. It comes from Apple, raising prices on Mac, iPad. Across the board, you're seeing these prices to counter the cost of memory and the memory shortage. This is the Micron story in many ways as well. And this stock is down by 0.4%, but that's the reality from the AI spend that we're seeing, that theme, the expense we're seeing, and the pass-through to the end consumer.
If you bought MacBook Air a couple of days ago, then congratulations.
Like Lisa.
You avoided a $200 increase for that MacBook Air because that price is increasing to $1,299 from $1,099. MacBook Neo, similar. Look, this again goes to the way that the AI trade is leading to inflation. As Stephanie was just saying, it is leading to real near-term inflation that you're seeing show up in consumer goods. Now, the big question here is, do you get demand destruction from this? Or do you ultimately just get people saying, ugh, really, again, and then plunking down their plastic?
Look at the commentary from the company. Rapid expansion of AI data centers created a memory surge. We've never seen a component price increase this much, this quickly.
Yeah, Kaching Micron. I mean, it's sort of an example of how quickly they were able to raise prices in 85% margins. But this, again, how much are we going to see this not just in Apple, but also in cars, also in any other component that you end up buying, any other consumer electronic that requires memory?
Tim Cook did warn us in an interview recently in the Wall Street Journal. He said it's unavoidable when it comes to raising the price of iPhones, and now it's the whole suite of Apple products. I hear this and hear what they're saying in terms of this is because of the AI build-out. This is another reason why the American voter in November is going to hate these AI companies and want them addressed. They want data centers in their backyard. They want their electricity prices going up. And no one wants to spend more on their iPhone.
How much longer can this go on? There is some runway here. We've been told that repeatedly, and Apple is telling you something similar this morning.
Yeah, we're not at a point where we're saying this is going to end anytime soon. The company was saying that they've shielded their consumers for months now with absorbing the price increases. They can't. And they said, ultimately, these constraints are going to last for a long time. We've heard the same thing from Micron. And guess what? I mean, this is why you could get hoarding. This is why people might say, oh, that's not great. But if you get in now, it's going to raise another $200.
People. Who's hoarding?
You nailed that trade, Bram. We'll give you that one.
Thanks. That's
all right.
the one thing I've actually
nailed. You can
nailed.
have that one. Apple this morning is down by about 0.75%. Micron is surging. Equity futures this morning up by 0.8%. PCE, on one read at least, a small downside surprise relative to expectations. That unlocks this move at the front end of the yield curve, down by 5 basis points on twos, your 2-year, a break of 4.1% so far this morning. The opening bell about 47 minutes away for equities. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. So recapping the data we just got. PCE, the Fed's preferred inflation gauge, meeting estimates, jumping 0.3% for the month of May. Jobless claims coming in at 215,000 last week, below the estimated 225,000. And personal spending for the month exceeding estimates, rising 0.3% versus the expected 0.2%. A change at the top of JP Morgan, the bank announcing Troy Rohrbaugh and Doug Petno, the co-CEOs of the Commercial and Investment Bank, will become co-presidents of the company effective immediately. Marianne Lake, currently CEO of Consumer and Community Bank, is retiring, the move fueling speculation about who will eventually replace CEO Jamie Dimon. Ford named the top mainstream brand for new vehicle quality by J.D. Power for the first time since 2010. Bloomberg's Matt Miller spoke to Ford CEO Jim Farley and asked him about the company's success.
That human motivation to pay attention to everything is amazing. Look, we make 85% of our vehicles in the U.S., Matt. That means these are U.S. factory workers versus even our domestic competitors. They're some of the biggest importers in the U.S. We're not building these vehicles in South Korea or Japan. These are American workers beating Toyota and Hyundai and our domestics who import their vehicles. We beat them all.
And you can hear Matt's full interview with Jim Farley at 9 a.m. Eastern. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Darius of 42 Macro on how the Fed could pose a headwind for markets. Right now, no such headwind. Equities bouncing up by 0.8%.
It's certainly better to see that your core PCE number came in lighter than I would say, even though it met consensus. There were many out there that feared it would be rounding up closer to 0.4%, which was a legitimate risk. The question, of course, is on a go-forward basis, what are we going to see in terms of the inflation data?
That was Stephanie Roth of Wolfe Research weighing in on the latest inflation data, 4.1%, a number we haven't seen going back some 3 years, April 2023. A small downside surprise if you look at something very, very specific like the headline number month over month, which was 0.4 and the estimate was 0.5. That unlocked this move in the equity market, up by 0.9% on the S&P, on the Nasdaq up by 2.4, adding some more weight to a rally that was really triggered by a massive move from Micron in the pre-market. We'll spend some time on that name in just a moment. In the bond market then, 2-year yields are lower off the back of that move on inflation, down by 4 basis points, 2s at 4.1%. Are you encouraged by the idea that this is as bad as it gets maybe through the summer? The headline's going to be Apple's raising prices. That's going to be the headline on inflation. You're going to have to pay up for your favorite electronic device.
Yeah, what's next, right? And that's the issue, is that this is a broadening out. If you take a look at the details of this particular report, Stephanie was just breaking them down in the break, saying that it is coming largely from international airfares. So thank you, World Cup, and all of those Brazilian fans coming here in first class, but also just in general because of oil prices and financial markets. Going forward, though, how much is coming from personal electronics, as well as the services sector that have to deploy more cash in order to buy some of those personal electronics to fuel their businesses? So a lot of questions here going forward.
Plenty of questions, and we'll spend some time on them in just a moment as we count you down to the opening bell. 40 minutes away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the stock of the moment. Micron shares are adding to gains, up 18.3% in the pre-market after it issued a blockbuster outlook and said that margins jumped nearly 85% last quarter. Its CEO saying that he expects the memory shortage to continue beyond 2027. And for that reason, as you said, we are now seeing Apple hiking prices on products like its MacBook. And this just confirms the bottleneck that we're seeing. And for that reason, we are seeing the entire memory trade up this morning, with SanDisk up 16% in the pre-market. But the broader chip ecosystem is also up because of Qualcomm. Shares are up 10.4% in the pre-market after it said that it expects $15 billion in annual AI data center revenue by 2029. It's a shift from a company that made its name supplying chips for smartphones, but now it's going all in on the AI infrastructure boom, and even said that Meta will start using its newest data center processors. And we end on a fun one. It is day 2 of Wendy's meme mania. Shares are up nearly 12% in the pre-market after they saw their best day in 5 years yesterday with a 26% pop. And it all started with a Wall Street Bets post to save the company that triggered what we're probably seeing as a short squeeze. So shares up again today. John.
Yahara, thank you. Thank you for the update. The bulls getting so much good news, aren't they? Think about it. Micron, fantastic numbers after the close yesterday, surging in the pre-market. Energy rolling over the banks, buybacks, dividend boosts, passing the stress test, all of that good stuff. Capital returns picking up. And then just a small, decent surprise on inflation. Tiny downside surprise on PCE. Something to worry about. Darius of 42 Macro says the Fed may elect to tighten now so it can ease even more later. Investors should buy the dip, but be patient. Trees don't grow to the moon, even if there will eventually be data centers in space. Darius joins us now for more. Darius, good to see you, buddy.
Great to see you guys.
Should I be worried about the outlook for this Federal Reserve?
Yeah, I'm not worried. I think they're, I said this with Tom earlier, I think they're going to play action pass so they can set up the run. They have to spook the markets and regain some of that credibility on inflation fighting, just so that they can create more scope to ease monetary policy in the ensuing year.
Let me just jump in. Is it a communication exercise? Can you achieve that through communication alone, or do you need to actually hike interest rates?
I think interest rates are the wrong tool. I think it's a balance sheet exercise, in our opinion, because we think they need to target the speculative excesses at the top part of the K-shaped U.S. economy. And so right now, the Fed's got to take reserve management purchases to zero and threaten the market that they may reinstate balance sheet runoff in order to take some of the, the pressure out of financial markets that's, leading companies like Apple to tighten, to raise their prices.
Is that what you're expected to see this summer? Or is that too soon?
In our opinion, based on our outlook for what the likely, sort of net result of the 5 task forces is likely to be, we think it'll be a dovish net result. Not all dovish, but a dovish net result. So in order for them to create scope for that, kind of create a runway for that, they're going to have to take some steam off the boil from an inflation fighting perspective in the coming months.
How exactly would that be effectuated with the balance sheet, and where in the risk asset market would you actually see the ramifications of that?
I think if the S&P 500 is down 10 to 15% and the Fed says, okay, enough is enough, you take the steam off the boil. I mean, right now we're annualizing on PCE, core PCE inflation at 3.5%, super core north of 4%. Now, these are some pretty uncomfortable numbers. And so ultimately, we know we're at peak inflation. Those numbers are going to come down, but the rate of change of those, that's deceleration could be an issue for the market in the context of what we just saw with Apple. Fun fact, I wrote my senior thesis at Yale about how a market-based economy can't have a single-payer healthcare system because it would drain resources from the other sectors of the economy and push up inflation. That's exactly what's happening right now with AI and Apple.
So right now, that's part of the reason why you're seeing inflation where it is. And you're saying that in order to lower that inflation, you need to see some sort of significant drawdown in equity markets. How are you positioning ahead of that, or how are you recommending positioning ahead of that?
Well, the first step of the trade, and we think it's already on, is the source of funds trade, where the investors are using, these sort of AI providers, particularly the hyperscalers, to capitalize the AI adopters and the businesses in the economy that have been left behind, not just in this particular market cycle, but for 10, 15 years. In our opinion, we think that trade is durable. We talked about it last time we were on the show. We think that trade is durable. It has multi-year legs. But if the market's down, 10 to 15% in S&P terms this summer or this fall, nothing's going to work. I mean, where do you hide out? Yeah, volatility.
Darius, it's good to see you.
Yeah,
it always is, buddy.
you guys.
Thank you, buddy. Darius Dale there, 42 Macro. Just another dimension, another way of thinking about this Federal Reserve. And there's a range of views right now because a lot of people are filling in the blanks because there were so many in the news conference just last week.
Yeah, we're all moonlighting as task force members because ultimately we want to know the answers. That said, is this a feature or a bug, the lack of understanding of the response mechanism for the Federal Reserve? And ultimately, you got people lining up on both sides.
But John, I think you asked the right question. Can you set deterrence alone just with communication, or do they actually need to deliver on that hike to actually show they really do care about getting inflation closer to target?
There's a sense they might have to deliver. For now, though, this equity market's enjoying what it's got. We're up by 0.8% on the S&P 500. Yields are declining. Inflation, a small, very small downside surprise. The debate continues. Coming up tomorrow, Alex Altman of Barclays, Eddie Fishman of CFRA, Russ Brownback of BlackRock, Cameron Dawson of New Edge Wealth, Bramo, Annmarie. Long weekend? Long weekend, is that what's happening?
Yes.
Good for you.
Lisa's working.
Bramo's working, just not on the show.
I'm taking
long weekend. Is that a long weekend? Rio again?
No, I'm not going to Rio.
Oh, no.
I'm going to
Aspen. Aspen for the weekend, darling.
Okay. Maybe I will too.
You're welcome to join.